digital cash. Some people don't care about that at all and are like, the blockchain is a really interesting way to do distributed computing and to build applications on the web that have interesting properties compared to the existing applications. So there's a lot of different missions, and there's like kind of one starting point, but it ramifies out in different directions.
Matt Levine of Bloomberg Opinion is still with us, and it's time for our lightning round. Matt, these are yes or no questions here that we're going to be asking you.
Yes or no?
You can handle it.
40,000 words.
Well, no, we want to start first by asking you, do you believe in crypto?
Sure.
Okay.
It's a yes or no question, sure.
Yeah.
Believe in it how?
Okay, yes. Is it trustworthy?
No.
Okay.
No. Just sticking with the one-word answers.
Okay, and is the current financial system a better option then?
I think the current financial system does more things at this point, but I think that crypto, makes interesting cases for taking over some things.
Okay, that was more than one word, but we'll let it slide. We also want to wade into the regulatory waters as well. Is Bitcoin or are tokens in general securities?
I think Bitcoin is not. That's pretty clear. I think tokens in general probably are. I think the SEC thinks that, and I think it's true. And I think that the next phase is going to be like the SEC figuring out how to use that, how to take that fact and regulate crypto in a productive way.
You drew me right into the next question. Is the SEC doing yes or no? Is the SEC doing a good job?
Oh, no. No, I sympathize. It's a hard job, but I don't think that they've struck the right balance. I think that they're not often doing a great job of catching really big scams, and they're also being a little harsh on people who are trying to do the right thing and are trying to find a regulated way to do crypto.
Yeah, regulation by enforcement is something we hear a lot on this show. All right, you played along, did your best to answer one-word answers. So let's just give you the final word here. You obviously wrote 40,000 words. This is a monster mammoth piece. Did you learn anything new? Did it change your mind as you were writing about this? Did you change your mind on anything?
I think it broadly made me more sympathetic to crypto. It made me see more aspects where people are working to build stuff that could potentially be useful and that is useful now. In terms of what I learned, I spent some time learning how Bitcoin works, right? And I think that what's interesting in the sort of project that I was doing is that you start from what is Bitcoin? How does Bitcoin work? And then you can kind of build from there. Crypto is still sort of small and new enough that you can almost understand all of it from first principles. You can almost start at the beginning and kind of go to the complicated world we live in today and kind of build it all from there.
To make a real impact, we need to go from 25% renewables to 70 to 85%. Digitization and decarbonization go hand in hand. 5G will really pioneer a much more sustainable future. I wish that I could.
We're live from Bloomberg's world headquarters in New York. I'm Sonali Basak.
And I'm Kaylee Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, we have the crypto story. We take a deep dive into the history of crypto itself in a special edition of Bloomberg Business Week written by our own Matthew Levine.
And stuck in the doldrums, Bitcoin is down roughly 1% this month, leaving fans wondering if and when October will come.
And a champion for crypto, Rishi Sunak officially becomes the UK's prime minister, sparking hope for more crypto policies in the nation.
All right, so all of that is ahead, but first let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. That is your function. And what you'll see is that along with other risk assets, it's a pretty up day for crypto. 2.5% higher on Bitcoin, now at $19,872. Remember, we've been sub 20K on Bitcoin for about 3 weeks now, which is our longest stretch under that level going back to late 2020. So we'll see if we can get a meaningful breakout above that today. Of course, you're seeing some outperformance for other coins. Ether up more than 6%, 1435 where we trade at the moment, and outsized performance as well for some of those crypto-related equities like Coinbase, the big crypto exchange. It's higher by nearly 9% on the day, and it's a greater than 9% move for Marathon Digital as well. So a lot of big moves out there in the intraday session, Sonali.
Intradays, but let's talk about the history here, because I know we're going to talk a lot, Kaylee, about where crypto is going. So where has it been? Bitcoin, even with it trading at less than a third of its market value at its peak, less than a third of its price at its peak, you still see it shooting up past 20,000 since 2009 when we really started seeing Bitcoin trading. Then Ethereum as well. When you saw it start up in 2015, you're still seeing it up more than 1,400 in terms of pricing. Fun facts, Kaylee, if you look at the market value of Bitcoin, even in the sell-off, you are still seeing Bitcoin trade at a market value that is greater than JP Morgan. And so it's come a long way in just a short amount of time, but clearly the question now becomes what's ahead and what is it used for?
All right, so let's try and get an answer to those questions. The latest issue of Bloomberg Business Week takes a special look at the story of crypto, where it came from, what it all means, and why it still matters. For just the second time in the history of the magazine, the entire issue is written by one single author. And lucky for us, he is joining us now. It's Matthew Levine, Bloomberg opinion columnist covering finance. If you have a question for Matt, go ahead and if you have a Bloomberg terminal, send us an IB, or you can send us a tweet. But we have a lot of questions for you first, Matt. This is a lot of material, 40,000 words. It's encyclopedic. Let's just start with what I find to be an interesting thesis within it. You write that your goal is to convince the reader that crypto is interesting, that essentially it has found some new things to say about old problems. What are those problems that crypto is solving?
So I'm, a finance person. I write a finance newsletter. I'm interested in finance, and I think that crypto tells a lot of interesting financial stories. So it's trying to solve problems like, how do we lend money? How do we trade assets? And crypto has done a lot of interesting things in that kind of field of problem solving. I think it's obviously the case that there are people in crypto who have sort of big, broader philosophical goals and who want to solve problems like, how do we trust the government?
Right.
Or like, how do we have a society? Or how do we have freedom? Or often like, how do we build an economy on the web? And so it's looking at a lot of those problems. And to me, sometimes the solutions there are a little bit less compelling than in the financial space. Mm-hmm. But it's sort of addressing a broad range of problems.
So what's the mission then, if you had to boil it down to a key mission? And do you think that after 40,000 words that crypto has solved or on its way to solving that mission?
Wait, the mission of crypto or of me writing this?
Crypto.
I think you succeeded in your mission.
Right.
Well, I think one thing that I wanted to sort of point out is that there's not really one mission of crypto. What there is like there's this sort of genesis moment in the Bitcoin white paper where Satoshi Nakamoto has some ideas for a thing that is digital cash and some kind of like philosophical ideas for why he's doing that. But people took that in different directions. And I think that there are a lot of people who work in, broadly speaking, the crypto space who have very different ideas of what the mission is. Some people are really into sort of the Satoshi like libertarian vision of like censorship resistant digital cash. And some people don't care about that at all and are like, the blockchain is a really interesting way to do distributed computing and to build applications on the web that have interesting properties compared to the existing applications. So there's a lot of different missions, and there's like kind of one starting point, but it ramifies out in different directions.
But is any of that really truly new? I mean, we've spoken with skeptics on this program who say this is just a different face on the exact same thing, that nothing really truly innovative is happening. For example, this all still needs to be converted back into dollars or some fiat currency at the end of the day for it to actually be worth anything. What do you say to those kind of arguments?
Oh, I think that there's some truth to that. I think that a lot of it is incremental, where it's building interesting ways to address problems that people were already addressing and that are not, I'm when people make claims that crypto is revolutionizing the world, I'm a little skeptical of those claims too. I think it's like an interesting incremental problem solver for some things rather than a sort of like whole new way of living. The converting back into fiat is definitely, a thing that I think about in terms of just like, I often write that it's hard to use Bitcoin to buy a sandwich. Every time I do that, people get mad at me and are like, I've bought sandwiches with Bitcoin. But no, I mean, I am in many ways a crypto skeptic myself. But I think that, one reason I wanted to write about it is that it has interesting things to say about the existing financial system, even if you're a skeptic of crypto as an investment.
Is it better than the existing financial system? Are there ways in which it's better?
It's better and worse. I think that when you talk to crypto, the first thing I'd say is that there are a lot of people in crypto who come from traditional finance, who are hedge fund people or high frequency traders, and something about crypto attracts them. And some of it is that you could get rich in a week, right? But some of it is that there is an intellectual interest to it, and it feels much more open. There's much more ability to build and to sort of innovate without getting permission from anyone. People talk about, like, if I start a hedge fund, I need to spend 6 months setting up contracts with a bank. Whereas in crypto, I can just sort of like plug into the computer system and do it.
So we're getting a question from the audience here, and the question being, why are crypto enthusiasts so mistrustful of the government, yet trusting of the pillars of the code stack?
Oh, that's an interesting question. So, I mean, the answer to that question is that in theory, you can audit that, right? Like the government, to some extent, is not going to tell you, you're not going to get like a transcript of every top secret meeting that the government does. Whereas like in crypto, the code is open source. Now, you may not be able to read it. You may not read it yourself. You may not have time. You may not understand it. But in theory, someone could, and there's a little bit less trust baked into that. But the other thing I'll say is that people in crypto are incredibly trusting of like con artists too. It's not just trusting the code. There's a lot of centralization in crypto and a lot of like individuals who get a lot of trust that they don't deserve. And I think that's a fascinating aspect.
Yeah, you write that. It says Satoshi invented a system in which I can send you Bitcoin and nobody else is involved. But what he actually invented was a system where lots of people were involved. So if that's true, how can the system be trustworthy?
Well, so that's an interesting innovation of crypto where what he's doing is one sort of like decentralizing transactions where sort of everyone involved in Bitcoin has some role to play in confirming Bitcoin transactions. And then the other thing he's doing is adding economic incentives for everyone to act honestly, so that if you are, if you're a Bitcoin miner where you're confirming transactions, you have good incentives to want Bitcoin to be valuable. And one way to do that is to not blow up the system by confirming fake transactions. So it's like a very clever, like, he's distributing it and he's creating incentives that make it work well.
We have another question coming in from a viewer. Do you think a CBDC, so central bank digital currency from the Fed, could crush Bitcoin? So essentially, can a digital dollar not coexist with something like Bitcoin?
The CBDC thing is interesting because to me, I think a lot of people at the Fed are skeptical of CBDCs because they say we have a CBDC. We have dollars are digital. Like we credit banks by pressing a button. We don't actually have to print them out and bring over a suitcase of money. And I think that the CBDC is in a lot of ways a way to make Fed policy and banking like a little bit more efficient, make payments a little bit more efficient. But I'm not sure it completely crushes crypto as crypto is, this is what I said about having many missions. One thing that crypto is like a set of equities in tech projects, right? And like that's not necessarily crushed by CBDCs. Another thing it definitely is avoiding government regulation, and that too, the Fed issuing a competitor
by
Bitcoin.
Nature
a lot of people, I would like a Fed competitor more than I might like Bitcoin, but a lot of people would say, no, I'd rather have the unregulated thing.
Well, while we're talking about kind of regulated monetary authorities, obviously we saw central banks have to come in and bail out the traditional banking system back in 2008. And you talk about in the piece how that's really what Bitcoin was born from. Satoshi did not like what he saw in 2008. And yet, ironically, you say that crypto had its very own 2008 moment this year in 2022. What did this year change, and why didn't it have the dramatic financial stability contagion impact that we saw during the financial crisis?
Yeah, so I think that one thing that is part of the sort of philosophy of Bitcoin at its birth is that leverage looked really bad after 2008. And like what the banking system is leverage. It's the banks borrow money from depositors and lend it to, mortgagees, and they, everything is kind of built on borrowing, and that looked really bad in 2008. That had like bad consequences. And Satoshi built this thing that is not built on borrowing, where if you send a Bitcoin to someone, there's no borrowing involved. You're not, lending to a bank. The bank is not lending to someone to buy a house. It's just its own thing.
But that's not what the system became at the end of the day.
No, right. And so one thing that happens is like Bitcoin then goes up, and all these people from hedge funds come in, and they're like, look, this is great. I'm making a lot of money, but what I really want is leverage, right? And so people from traditional finance came into crypto and said, let's build margin lending. Let's build, lending products generally. And so then you had this very leveraged system that ended up looking a lot like the banking system in 2008, but much less regulated.
So does that mean the deleveraging of 2022 in crypto was a good thing for the system because it kind of washed out some of the bad behavior? Or do you think that some of those behaviors can still exist in the system and therefore make it inefficient in some fashion?
Well, I think it definitely washed out some of the really bad stuff. I mean, I think that, I joke a lot about crypto just relearning the lessons of traditional finance. And I think like one, kind of brute simple lesson of 2008 is you shouldn't run a risky business with like 3% capital. And you look at some of the crypto lenders, which had, they weren't like holding mortgages, they were holding like Bitcoin, which is much more volatile, and they were running at 3% capital, sometimes less. And I think that, I hope that people learned that particular lesson of not running a centralized business with a tiny sliver of capital. But I think it has washed out a lot of excesses, but certainly there's a lot of excesses still to be washed out.
While we're talking about bad things, usually Ponzi scheme has a bad connotation. Is that essentially what all of this is? You reference a few Ponzi-esque behaviors in your piece. You talk about Olympus, for example, a DAO, which things didn't turn out so well for. I mean, do you think broadly, ultimately, at the end of the day, it's Ponzi? That's what it is.
Well, I mean, I want to reclaim the term Ponzi a little bit. I mean, like one thing that Bitcoin is that a lot of people thought it was valuable, and so its value went up, right? It's just this purely socially created value. And that's not unrelated to a Ponzi scheme, right? There's no like cash flows, there's no underlying intrinsic value. It's just what people think it's worth. And yet today, I think most people think that Bitcoin has like a pretty enduring value.
The rest of the way, the S&P drops about 23 points and the NASDAQ continues to fall. It's been a rough go thus far for big tech, falling 1.6%, a drop of 178 points. For a closer look at the markets, let's bring in James Liu, Clearnomics founder and CEO, and Michael Landsberg, Bennett's Private Wealth Management Chief Investment Officer. Nice to see you both. Michael, we'll start with you. What are you learning in this market the last couple of days?
I think what we're seeing is earnings aren't particularly good. A lot of people are talking about beating expectations, but 180 stocks so far reported roughly of 500 S&P. Earnings growth is negative 3% year over year. Even great names like McDonald's, they beat expectations, but in reality, they did $2.86 a year ago. They did $2.68 this quarter this year. It's deceleration in earnings. It's something that we got to keep an eye on.
James, what do you think? Here we are looking at a day where we're seeing a bit of a mixed action. Dow holding on to gains, S&P still above 3,800, but ending the day in the red. I guess the moves that we've seen over the last couple of weeks since we last spoke, have they made sense to you? And what does that signal?
Yeah, well, Shauna, basically you are seeing this divergence across sectors and across major indices. Obviously, tech is dragging things down right now as we speak. Those earnings are being hit hard. But when you look at overall earnings, those are coming down a bit because of the sluggish economy. But earnings estimates are still around $220 for full year guidance. Now, again, those will probably come down a bit. They're probably a bit too lofty. But even if they come down, and we're talking about 8% earnings growth, that's still actually quite strong. So it really depends on the specific sector and the overall market that we're looking at. But then it becomes a question about the Fed, and that's where today's GDP report was strong. So, basically we're going to have to look very carefully at the earnings numbers over the next couple quarters to see if the earnings guidance that we're seeing right now does play out.
Yeah, and Michael, you mentioned your thoughts on earnings thus far. What does the GDP number up 2.6% tell you is coming?
I think it tells me the Fed, this idea of a pivot's not going to happen. Fed's been raising rates and the GDP, hasn't really gone down. It's been able to grow this quarter. We expected a little bit of growth this quarter. Hasn't really gone down. It's been able to grow this in fourth quarter and first quarter. But the idea of a pivot here, I think, is crazy to me. I think people are rallying the market thinking this is not going to happen. But I think the Fed to go up quite a few times. They'll be higher than many people want. I think you need a position for that.
How aggressive, Michael, do you see the Fed potentially getting there?
I see at least the next three meetings. Obviously November, December, and then obviously late January, February. Just because I think what they're seeing now is it really hasn't hurt. Unemployment's still very strong. GDP numbers here are strong. So I think their goal is, and Powell seems like a student history. When I look back to the 80s, Volcker raised rates a lot to get it above, Fed funds were above CPI. And I don't know if we have to get there, but we certainly, I think, are in a spot where they're going to continue to raise. ECB raised 75 basis points this morning. I think it's basically full raises ahead. Again, I'm not saying I want that, but I'm looking at what's happening. I think that's what we're going to see.
James, your thoughts on the next three meetings continuing the Fed hikes?
we do think that the Fed is going to have to continue to hike, not just because that is the path they're on, but also because inflation not only hasn't come down, but it's gotten worse. And even if it does come down, it's going to take a while for it to get back to even, anywhere close to the Fed's target. So, you look at today's GDP report and it's positive, but of course, good news is being interpreted as bad news in the market. But what the GDP report really tells us is that it is not inevitable or unavoidable to have a hard landing. It is possible, theoretically, to strike some sort of balance here. And really, that all that means is that the Fed is probably going to keep raising rates until we do see unemployment start to tick up, until we see growth start to slow a bit further. But it's also possible that many sectors still continue to outperform in that environment.
Michael, where are you seeing the most opportunity, just given all the volatility that we have been seeing? We're waiting for Intel, Amazon right now. Given the losses that we've already seen in the tech sector, is there an opportunity to buy there?
In tech, no. To me, it looks like tech is the area that will continue to be, again, had the best gains the last 3 years. It's going to suffer the worst here in an environment where there is some deceleration. Certainly seen it across the board with some of the ones that have already reported. I think you want to stay out of that space. If you want to look at healthcare, things that do well in a recession, healthcare, staples, and particularly like discount stores and utilities. I'm still a fan of the U.S. dollar, and I think that's the places you want to be. Again, at some point, there's some good tech companies, maybe one-offs, but as a sector, they've had great runs. I think they're going to give a chunk of them back and continue to do that.
James, are we anywhere near a buying opportunity in big tech? And what are your expectations the rest of the way? We've still got the Apple and Amazon numbers coming out here any minute.
Yeah, so we generally would prefer the consumer sectors a bit more. Those sectors are challenging because obviously inflation is hurting consumers and the housing market is going to hurt households. However, you look at the earnings growth that we're seeing in those areas, and that's still a bright spot in this economy. And so although there's going to be challenging times in the consumer sector, that's really what we prefer. Tech, we would still be in a holding pattern here. There are just too many things playing out, especially very stock-specific, non-macro activity that's happening that's affecting those stocks.
Okay, got to leave it there. Got some news coming in. James Liu, Michael Landsberg, thank you both. Appreciate that. We got to get to Amazon earnings. They are in. Ali Garfinkel is going to break them down for us. You can see stock moving at this hour. What are you seeing, Ali?
Yeah, Dave, Amazon shares are tanking on results, down almost 20% after hours. And this is mostly on Q4 net sales guidance. It was a pretty big miss. They're guiding to 140 to 148 billion instead of 155 billion. And the numbers coming down for today for this quarter are not what they hoped for either. Revenue was a miss. It came in at 127 billion versus 127.6 billion expected. Adjusted EPS was a beat, came in at 28 cents actual versus 22 cents expected. And Amazon Web Services came in just a little bit short, 20.5 billion rather than 21 billion. And what's going on here, Dave, is they're saying they've been hit by the macro environment. They're working on improving fulfillment, but this is not what they were hoping for today.
Certainly is not. Ali Garfinkel breaking those Amazon earnings right now, and you can see shares plummeting 17% after hours. Shauna, the big tech, big rout just continues. The macro environment just looks awful, even for Amazon.
It does, even in the retail space, which Amazon obviously focused into, as well as cloud, the AWS miss that Ali just mentioned, obviously a huge reason why we're seeing such significant losses, coupled with the light guidance that we've seen, again, off just around 17%. Taking a look at some of these other numbers here, or what they also said in this release, saying the unfavorable impact on revenue of 460 basis points from FX. We've been tracking the strong dollar, what this means here for a number of tech companies over the last couple of quarters and what it could mean for the current quarter. We know that guidance for Amazon is so important given the holiday quarter, what we are in right now. So the fact that that came in weak and pretty significantly, they're expecting 140 to 148 billion. The estimate out there was for 155 billion, Dave. So obviously a huge miss there, and that's why we're seeing the stock off just around 17%.
Any good news stand out to you at all in this report? I'm searching for some, but I'm not quite seeing any. It kind of echoes the Jeff Bezos batten down the hatches remark that we heard, what was that, a couple of weeks ago?
It does, certainly a slowing economy. I guess if you want to point to some good news, that EPS beat of 28 cents, the estimate was for 22 cents. That's obviously better than expected, but we're really seeing that guidance. That's really the narrative here, and that AWS miss. So I'm certain that analysts will be looking for more information on that on the call, and we will be getting analyst reaction in just a few minutes. All right, I want to turn to Intel. Intel is out with its earnings report and taking a look at how shares are trading. Look at that, a bit of good news here in the tech sector, up just around 2%. Taking a look at some of these numbers, third quarter revenue of $15.3 billion. That was basically in line with what the street was looking for. EPS, a big beat there, 59 cents. The estimate was for 33 cents. Fourth quarter revenue and profit and revenue guidance coming in just a bit light. Their full year adjusted revenue also missing the street's expectations. Intel, though, highlighting cost-cutting measures, what they're planning to do in 2023. Maybe that has the street a little bit excited there. They're looking to cut $3 billion in costs next year, saying that they are aggressively addressing some of those issues, some of those cost issues. So again, revenue basically in line, a big beat on EPS. We're seeing the stock up just around 2% here in after hours. All right, coming up next, Amazon shares once again sinking after hours, off nearly 20% following that poor fourth quarter guidance. We'll get analysts to take next.
At Vulture, we've got new cloud locations popping up everywhere, just like NFTs, breweries, scooters, fancy donut shops. Deploy your website, mobile app, or anything else in seconds on Vulture Cloud. Get started today at vulture.com.
春眠不觉晓，
处处闻啼鸟，
处处闻啼鸟。
Look at me, please. Look at me, please. Look at me, please, please, please.
English 在线直播课推出了中文和英文体验课，双科免费试听。中文直播课由中国本土老师使用沉浸式教学法授课，英文直播课由专业英美外教1对1授课，更专注、更高效。根据孩子不同的语言水平，采用不同版本的课程授课，以动画加儿歌加游戏的形式，培养3到15岁孩子对中文加英文的学习兴趣，在家用平板或电脑就能学。现在报名可享受特惠的价格，还免费赠送电子学习大礼包，中文、英文都能学。赶快点击视频下方链接，给孩子报名抢课吧。
Amazon, look at that, off just around 18% following their earnings release. Fourth quarter guidance coming in a bit light. Also, AWS revenue there during the quarter, $20.5 billion, missing the street's expectations for $21 billion. Here to break all this down, we want to bring in Arun Sundaram. He's CFRA's analyst. And Arun, when you take a look at the results that we just got, taking a look at the reaction in the stock, off just around 18%, what's your takeaway?
Yeah, I mean, I guess we shouldn't be surprised to see some, big tech sell-off. It seems like when companies do miss these large cap names, we're seeing large sell-offs. We saw that earlier today with Meta. But the big theme here, I think, for the sell-off and after hours is the guidance. The guidance was, especially the sales guidance, was well short of consensus. Amazon's guiding for Q4 sales of 140 billion to 148 billion. Consensus was around 155 billion. So that's about 5 to 10%, short of consensus there. And even on the bottom line, the guidance for Q4, they're looking for between $0 and $4 billion of operating income, and consensus was about $5 billion for Q4. So I think this reaction is really based on the weak guidance, and it's due to these macro factors that we've all been talking about, a softer outlook. And now it looks like, we knew Amazon's e-commerce business was slowing down, but now we're also seeing that trickle into their AWS business, which has historically been the much faster growing cash cow for Amazon. So we're now seeing, AWS low, which is similar to what I think Microsoft reported earlier this week. They saw a similar effect as well.
And that's what I want to ask you about, the AWS number. That's largely been the investor story for quite some time, far more so than the retail business. What does it tell you that number disappointed?
Yeah, I think we have to listen to the analyst call later today, but I think the reason for that slowdown, so if you look at operating margins in AWS, it was 26.3% this quarter. The consensus was about 29%. And I think the big culprit there might be due to higher energy costs. To power these AWS servers, it's a lot of natural gas, electricity. I think that's a big culprit there. And also, I believe stock-based compensation was higher than expected. Amazon's it's having to pay a lot to hire and retain a lot of their engineers in their AWS business. So I think the combination of higher energy costs and higher stock-based compensation is really the reason for that margin hit in AWS.
What do you think this means just in terms of the pressure that CEO Andy Jassy is going to be under to further cut costs? Do you think he's going to have to face a little bit more on that front because of these results?
Yeah, certainly. This has been a talking point at Amazon for the past several quarters now. Like I said before, we knew demand was normalizing, especially in the e-commerce business. And the goal for Amazon this year was to really cut down on their fixed costs and really right-size their capacity to match these new demand trends that they're seeing. So in that sense, even though revenue growth is slow, it shouldn't have major impact on margins because they're focusing on their cost structure and cutting expenses. So I think that's going to be something that Amazon will continue to work on throughout 2023. I think now we're going to maybe see some cost cutting in the AWS business, since it does look like revenue growth is slowing in that business as well. Previously, we really saw most of the cost cutting in the e-commerce side of Amazon, but now it looks like they might shift that playbook to their cloud business as well.
It's largely been the Andy Jassy narrative, trying to undo some of that spending and massive growth under his predecessor and cut his way to some wins. Look like there's some more ahead. Not a huge part of the investor story, but the streaming aspect of it, subscription services, certainly gets a lot of ink. And it's interesting to see that number disappoint as well. Again, a lot of attention on Thursday Night Football and Lord of the Rings sequel. How disappointing is that?
Yeah, the subscription revenue came in at 8.9 billion. Consensus was around 9.2 billion. We also projected around 9.2 billion of subscription revenue growth. And I think you also have to lump in advertising into that. Advertising is a growing part of their business, especially as they grow out their Prime Video streaming service. At least on the advertising side, that did beat consensus slightly. We saw about 25% growth in advertising. Consensus with 24% growth. We actually thought they would grow their advertising business by 35% this quarter, so slightly below our expectations. And really, the reason why we think advertising is poised to growth for Amazon is because Amazon was historically a major e-commerce advertiser, but now they're really shifting gears and becoming a major video advertiser with the growth of their Amazon Prime platform. we're seeing all this new Amazon Originals. The highly anticipated Lord of the Rings series got released in September. Thursday Night Football. These are, these programs cost Amazon a lot of money, and they're hoping that turns into really strong growth in their advertising segment and also their subscription segment. So yeah, we did see some weakness or some weaker than expected results in subscription and their subscription segment, but I think that made up for it a little bit on their advertising side.
So I guess how much of this is really a timing issue? And then when we look ahead to the call that's going to get underway, what's the number one thing that you want to hear from management?
Yeah, I mean, the number one thing I'm going to be looking out for is how are they going to continue to right-size their capacity to match these new demand trends that they're seeing. Amazon is a company that runs on a heavy amount of fixed costs, so you need these fulfillment centers and warehouses to really run on optimal capacity to generate strong margins. And right now we're not really seeing that. So we're going to be looking for things that Amazon are doing to cut future projects, cut CapEx spending, especially among their fulfillment network. If you think of how much Amazon has invested in their fulfillment network over the past 2 years, it's incredible. And now I think the goal is to cut back on those expenses and allow Amazon to grow into that overbuild that they created over the past 2 years.
And they cut their way to some wins. A rough report for Amazon. You can see shares down about 19% after hours. Aaron Sundaram, thanks so much for being here. Appreciate that. Coming up, Intel moving after hours as well. You can see it up. There's some good news, up 7.3%. We'll take a closer look at the chip giant's quarterly earnings next. All right, Intel moving up 7% after reporting Q3 earnings. We have Matt Bryson, Wedbush Securities Senior Vice President of Equity Research and Hardware, with us for more on the chip maker. What are you seeing? What's your reaction to Intel's report?
Honestly, I'm a bit surprised the stock's up. The report was fine. They did better on the PC segment than I'd been expecting. And expectations were clearly low heading into the print. But again, they had to take guidance down for Q4. Last time they talked to us, they were talking about Q3 being a bottom, then taking some inventory out of the system, and then things would pick up again in Q4. And instead, they've guided for Q4 revenues to decline, gross margins to come off. So clearly Q3 wasn't the bottom.
When do you expect to see a bottom, I guess, when you take a look at this stock? Because we heard from Gelsinger, he wanted it to be in the third quarter. And then when you take a look at that cost-cutting measure, I guess, how much of that do you think is the reason why we're seeing, look at that, the stock now up just over 7%?
Yeah, no, I think certainly the cost-cutting helps, right? I think that one of the concerns is that Intel's over-investing. I do think they have to invest to catch up. But having said that, it seems like they're investing everywhere, maybe in terms of reducing headcount in some places where there isn't quite so bright a future. That's the right thing to do. Also, if you look at their capital expenditures, those came down by $2 billion. So free cash flow won't be quite as bad as it would have been had they not cut CapEx. And so that certainly could help. And again, expectations were rock bottom heading into this quarter, given how difficult a time Intel's peers and other suppliers into the server and PC markets have had this past quarter.
Certainly seeing that PC slump there, sales down 15% overall in the industry. You're talking about their peers. NVIDIA said those Chinese chip restrictions should cost some $400 million. How do you expect that to impact Intel?
So as of right now, it's not clear. Certainly Intel is struggling with the fact, and everyone's struggling with the fact that the Chinese consumer is a whole lot weaker than anyone would have anticipated 3, 6, 9, 12 months ago. But in terms of the enterprise side of things, Commerce is not really targeted server chips yet. I think that's where the risk is to Intel. Having said that, again, even the Chinese data centers, cloud providers haven't been spending as much. And again, I see that weighing on Intel the same as it's weighing on AMD, NVIDIA, and everyone else.
Matt, what would make you a little bit more positive on Intel, on the name, as you look out into 2023?
So I think 2023 is going to be a rough time for Intel, almost no matter what they do, in the sense that I think AMD's ahead in terms of transitioning to the next server CPU. On the PC side, it's a rough PC market out there. There's not much they can do about those two factors at this point. What would get me more positive is all of their struggles have really come down to issues on the manufacturing side. And so if they're able to put out more concrete details around how Intel's transforming itself to get their manufacturing back up to speed, parallel with that of TSM, that would make me feel a whole lot better about the story going forward. And so it's not so much for me about 2023, it's what does 2024 look like, what does 2025 look like? And right now, I just don't have the visibility to say Intel's fixed their manufacturing problem. So yeah, 23 might be a bad year, but you're not investing for 23, you're investing for Intel to be the best provider of server CPUs, PC CPUs in the world.
Part of the reason they'll spend that $20 billion on that Ohio factory. Shocking to see they lose half their market cap year to date. So what's the one thing that could reassure you that you could hear from Pat Gelsinger in the call upcoming?
I think the one thing I'll be looking for is on the PC side of things. I was a little bit surprised that the business actually grew Q3 from Q2. And so I guess one of the details I'll be looking for is that wasn't them pulling in some business, and that PC rebound is something that that will have a bit more in terms of legs for them, and that I don't have to worry about there being a bit of excess inventory out there, because again, everyone else you look at had a really, really difficult Q3 in PCs.
All right, Matt Bryson, great to have you. Thanks so much for joining us again. Intel shares popping in after hours, up just around 7%. All right, coming up, we're waiting on earnings now out from Apple, due out any moment. You can see the stock reacting to the earnings that we actually got from Amazon. So here it is ahead of those results, off just around 2%. We'll get analyst reaction as soon as it breaks. Plus, President Biden catching plenty of heat for high inflation. Find out how one decision he made could come back to haunt Democrats in the midterms. Stay tuned.
President Biden catching the blame for high inflation that's wrecking family budgets. But the question remains, could the president have done something differently? Yahoo Finance's senior columnist Rick Newman here to tell us. Rick, what could he have done?
So I think 2 weeks from now, when the midterm elections are over, I think we're going to have a lot of recriminations among Democrats about what they could have done better or differently leading up to the midterms, because they're probably going to get shellacked. And the Harvard economist Ken Rogoff wrote something in Foreign Affairs that caught my eye. He goes back to the decision to reappoint Jerome Powell as chair of the Fed. And, you know, this decision was underway at the White House in the summer of 2021. And Biden did not choose Powell. And if you go back to then, there was a chance that Lael Brainerd, who's now the Fed vice chair, she could have gotten the job. Biden could have recast the central bank. So he didn't make that decision to reappoint Powell until November of last year. He could have done that sooner. And this gets to the question of why the Fed seems to have waited so long to raise interest rates. They did not start raising rates until March of this year, when inflation was already at 8%. And if you go back to the summer of 21, when Biden was trying to decide who should run the Fed, inflation was already hitting 5 and 6%, so well above the Fed's target at that point. And Rogoff in Foreign Affairs basically speculates that The Fed under Jay Powell did not start raising rates at that point last year, mainly because Jay Powell was campaigning to keep his job. And, presidents don't usually like higher interest rates. Biden's not the only one. So the theory here is that the Fed under Powell actually delayed raising rates because Powell was waiting to see if he would get reappointed. Now, Powell is never going to tell us if that's actually true, and I don't think reporters will even ask him about it. But let's say that had happened. Maybe the Fed had started raising rates sooner and inflation would be lower than 8.2% at this point. It's a counterfactual. We're not going to know, but it's an interesting theory.
Yeah, they were certainly behind the curve. I thought you were going to say the Biden administration could have spent less money. That is certainly the other criticism out there. How might that have helped?
That is the Republicans' main criticism, and we're talking about not the Inflation Reduction Act so much, which has passed but hasn't really gone into effect yet, but the huge stimulus bill from early 2021, which Biden championed and then signed. And we now know that was probably way more fiscal stimulus than necessary. So we got more fiscal stimulus than we needed. We got more monetary stimulus than we needed. And that is why we have inflation now. Now, a year ago, we were still in this debate of is inflation transitory or is it going to be lasting? And we know now it wasn't transitory, it was fairly lasting. And this is probably the biggest factor that's dogging Democrats in the last few days before the midterm election. So they're going to have to live with their decisions from 2021.
Indeed they are. Check out Rick Newman's piece on Yahoo Finance today. Good to see you, sir. Thank you.
Hi, Dave.
All right, another day, another sign of weakness in the crypto industry. Crypto stocks down around 55% year to date, and today's shares of crypto mining operator Core Scientific down, let me check, down 78% over solvency concerns, a wipeout. Yahoo Finance's David Hollerith has the details. David.
Core Scientific said in an SEC filing today that it's not going to meet its debt payments for October and November. The company said it's exploring a number of alternative capital structure options to meet debt eventually, but also noted that this could include filing for bankruptcy, in which case stockholders would be out of luck. The context here is that Bitcoin mining companies typically take a lot of capital expenditures up front, and that's to pay for equipment, mining facilities, and this consistently high power draw that they need to power their machines. And those expenditures have been much tougher to meet in recent months for Core. And part of that comes down to the fact that the company's daily revenue is getting squeezed on both sides by both a higher electricity prices, and then on the other hand, a lower Bitcoin price, which means what they're earning is costing less, if that makes sense.
It does indeed. David Hollerith, unfortunately, got to leave it there. Got some breaking news coming in. Thank you, sir. Shauna.
All right, let's take a look at Apple shares extending those earlier losses. You can see, oh, look at that. Now it was off just around 4%, now off just around 1%. Jared Blickery has the numbers for us. Jared, what's going on?
Yes, easy come, easy go. Let's get to those fourth quarter results. Revenue beating street estimates, coming in at $90.15 billion. That is up 8% year over year. Estimate was for lower, $88.64 billion. And then when we break this down by segment, iPhone revenue, that was a slight miss. You could almost call it in line, $42.63 billion. Street estimating $42.67 billion. That's up 9.7% year over year. Mac revenue beating handily, $11.51 billion. That's about $2 billion over the street estimate. iPad revenue coming in a bit light, $7.17 billion versus estimates of $7.81 billion. And then wearables, $9.65 billion. That's up 9.8% year over year. And that is about $1 billion higher, just a little bit less than that, than the street estimate of $8.8 billion. Now, let's take a look at service revenue. That came in at $19.19 billion, and that was less than the street estimate of $19.97 billion. Still up 5% year over year. And now here's another key stat. Greater China revenue, $15.47 billion. That is lighter than the estimates of $15.65 billion. And then finally, EPS, that's $1.29 coming in versus the estimates of $1.26. So beat the street number by 3 cents. Oh, I do have a couple more numbers here. Gross margin, $38.1 billion. That beats the estimate of $37.31 billion. And then here's a miss that people might fixate on for a little bit. Cash and cash equivalents coming in at $23.65 billion. That's about $4 billion light of the estimate of 27.63 billion. Not that Apple needs any more cash on its balance sheet, but it is interesting that declined 32% year over year. So overall, Apple was already down 2% based on those Amazon results. So it's actually up a little bit since then. We'll have to see what comes on the call, guys.
And Jared, all eyes are going to be on that call. Again, I guess when you stack Apple up against some of the other tech giants, these numbers look pretty good, which is probably why the losses that we're seeing after hours aren't that significant. Again, just barely in the red, now off just around 1.5%. So bumping around just a little bit. When you take a look at that China number, obviously that was a huge focus here. International sales, that coming in a bit light, 15.47 billion. Estimate out there, Dave, was for 15.7 billion. iPhone revenue, we know that's so critical for the company. Like Jared said, that coming in just a bit light. So I think that analysts are just kind of trying to digest these numbers when you take a look at maybe some of that slowing growth there and what that could mean for the company in this very important holiday sale quarter.
You could argue you thought shares would fall bigger, being that all three areas they were being watched here, really. iPhone demand, we saw a slight miss there. Services, a miss there. And China. So those are really the three biggest areas. And still, shares, down, but not terrible at 1.7%. There are already some comments to CNBC from Tim Cook that says they would have grown double digits if not for the strong dollar. Talked a lot about FX. Quote, the foreign exchange headwinds were over 600 basis points for the quarter. It was significant. We would have grown in double digits without foreign exchange headwinds. So again, not terrible, but certainly not what you've come to expect from Apple, and really just reflects a larger bad macro environment for all of big tech at this juncture.
It does, it certainly does, really highlights the strong dollar, what that's doing here for so many multinational companies. When you take a look, though, of the fact that Apple did report that its active install base of devices reaching an all-time high, their CFO making some comments saying that the strength of our ecosystem, unmatched customer loyalty, record sales, spurring that number to get devices to that new all-time high. But again, not enough here. When you take a look at that iPhone number, shares off just around 1% in after hours.
All right, coming up, we see the Apple shares moving down just 1% at this hour. After hours, we'll take a closer look at the fourth quarter earnings, break them down for you next.
Apple turning positive. Look at that here. After hours revenue coming in better than expected, up 8% year over year, $90.15 billion. iPhone revenue coming in just a bit light, $42.63 billion. Street was looking for $42.67 billion, so just missing Wall Street's expectations. Here to break down the report, we want to bring in Ivan Feinseth, the Tigris Financial Partners Chief Investment Officer. So Ivan, when you take a look at the after hours action, we've been bouncing around just a bit. We were off 4%. Now we're back in negative territory, off just around 0.5%. What's your initial reaction to this report?
It was a great quarter. I mean, yes, it missed slightly in some areas, but the macro environment's tough. So to do the job they've done in this quarter is very good. And, FX has been a significant headwind. And unfortunately, sometimes foreign exchange is a headwind. Sometimes it's a tailwind. It's been a massive tailwind. But most importantly, the iPhone 14 was only available to ship in the last week of the quarter. And they could have shipped more, but they also face supply chain constraints. So they are not able to build the number that they need to. So the demand is strong. And the slight misses in this environment, I think, makes it an incredible quarter. And I think any weakness is a major buying opportunity.
So all the concerns over waning i14 demand issues, you think much ado about nothing when you look at this report?
Absolutely. I mean, they really, they missed by, less than a percentage point in most areas. It was just so small, and given in this environment, it's a phenomenal job, and the demand is there. And key, while the services revenue, again, slightly weaker, it's about growing the ecosystem and expanding the services base. And they also just announced a services increase for Apple TV, the Apple Plus bundle, Apple Music, and several of those services by $1 to $2 a month, which, based on their massive user base, is a significant amount of money. Not that, significant to the consumer, but certainly very significant in the aggregate for Apple, which kicks in, next quarter.
Yeah.
So there's a lot of wind at their back.
Yeah, Ivan, I wanted to ask you a little bit more about that bump up in price, what that would mean for Apple in the current quarter. Well, I guess more so looking out to 2023. You mentioned it will boost their revenue. I guess by how much is the question? What are you forecasting?
I don't have the number. They have, I think, 800 million active users. And so by $1 or $2 a month, you multiply that out, and that's a lot of money. I mean, it's, let's say it's $1 billion, another $1 billion a month remember that this incremental price increase is mostly profit. I mean, I'm sure costs have increased, and certainly in the case of Apple TV, the cost to produce content has gone up, and the need to pay people more has gone up, but the incremental increase to revenue is much more significant than the incremental increase in cost. So it is a net positive, and they still offer a great value. And Apple has a very loyal customer base, and they are still a long way into a massive upgrade cycle. There are a lot of people with iPhone. I know people with iPhone 8s, but certainly there are a lot of people with older iPhones that will be, 1 to 2 years into their contract that will be eligible to upgrade next year. So this upgrade cycle is pretty powerful. And the other important thing to remember, that demand is strongest for the more expensive phones. So consumers want the Pro and the Plus and the more expensive phones, because consumers are willing to pay up for phones, for smartphones, and for the service, because it's such an integral part of people's personal and professional lives.
Yeah, the demand all on the Pro side. Another question coming in was the impact of the China COVID lockdowns. Ivan, what are we seeing there? Are you able to take away anything from that?
Well, they did report strong China results, but China has been under the, they have this zero COVID policy. They locked down right away, and it has been disruptive to companies that do business in China, as well as China's own economy. But, eventually, hopefully the COVID issues will subside, and then the economy there will pick up. So I think Apple is in a great position. The stock has been down, and I think it's a buying opportunity here. And I always say any weakness in Apple is a buying opportunity, and history has shown that to be the case.
Yeah, no guidance since 2020. So what are your biggest lingering questions for the call?
Well, I think the most interesting thing, especially with what's gone on with Meta platforms, is that the anticipation of an introduction of a virtual reality headset from Apple and what that looks like and how that integrates also into their services revenue, because they already have a operating system for their virtual headsets that has been launched, and they also launched tools for developers to start to make content for that. So we have a whole other wave that is very fascinating of additional potential sale of hardware and software and services. So there's still a lot of exciting things ahead. And the fact that the wearables market continues to grow with the new launch of the Apple Watch, the Apple Ultra Watch, and the new AirPods. Again, there's a huge upgrade cycle for that. And that is already proving out.
So overall, Ivan, it's been a gloom and doom story in tech, no secret there. But what does this report tell you about the environment as a whole, the macro environment and the headwinds?
It still exists. It's a tough environment, but yet Apple, I think, is enduring pretty well. So to have these just tiny shortfalls from expectations that are almost insignificant is a major positive.
Chalk it up for another W for Mr. Cook. Ivan Feinstein, good to have you, sir. Thank you. All right, let's get it over to Shauna for what's moving after hours. Hey there.
All right, Dave, we were just talking about Apple. We also have Amazon, Intel, Pinterest, and Deckers. Let's kick it off with Apple. I know we just reviewed it real quick, but taking a look at this reaction after hours, now back in negative territory, off just around 1%. Revenue coming in better than what the street was expecting at $90.15 billion. That's up 8% year over year. iPhone revenue coming in just a bit light, $42.63 billion. Street was looking for $42.67 billion, so just a small miss there. Strong dollar obviously cited as a headwind here in Apple's most recent quarter. Active install bases of devices hitting an all-time high. Very important here. Over the past 3 months, you can see Apple's off just around 7.5% year to date. Stock off around 18%. Let's take a look at Amazon. Very different story here after hours. The stock selling off just around 17.5%. It did hit the lowest level that we have seen Amazon trade at since March 2020, earlier in after-hours trading, shortly after these earnings were just announced. AWS revenue missing guidance for the fourth quarter, the current quarter, holiday sales quarter, coming in just a bit light. That's a big reason why we're seeing the stock take such a significant hit here after our fourth quarter guidance. $140 billion to $148 billion. The street was looking for $155 billion. Taking a look at Intel, that's actually moving to the upside. You can see it up just around 6% in after hours. Revenue coming in a bit light. EPS did come in better than expected at 59 cents. Estimate was for 33 cents. I think a big reason why we're seeing this pop after hours has to do with the cost-cutting measures that was just announced from the company, and that includes they're looking to cut costs by $3 billion next year in 2023. Fourth quarter guidance also coming in just a bit light, but again, that move after hours, a lot of that coming with the cost-cutting measures that Intel has just announced. Taking a look at Pinterest, that stock popping here, soaring after hours, up just around 15%. They beat on revenue, beat on adjusted EPS. Revenue coming in $685 million, adjusted EPS of 11 cents. Monthly active users, 445 million. The estimate on the street, 440 million. Year to date, the stock off just around 39%. Over the past 3 months, we've actually seen gains in Pinterest, up just around 14%. And taking a look at Deckers as we round out these after-hours movers here, off just around 8.5%. A lot of that has to do with the guidance that we just got from the company. They maintained their full-year net sales forecast, but that came in lower than what the street was hoping to hear. EPS beat sales $876 million for the most recent quarter. The street was looking for $805 million. Over the past 3 months, Deckers has actually outperformed by a wide margin, up just around 27%. Year to date, though, a bit of a different picture. You can see it just in the red, off about 2%. So, Dave, comparing that to what we've seen play out in the broader markets, it's actually been an outperformer.
Yeah, climbing out of a deep hole. Shauna, thank you. Good stuff. My stock to watch for Fridays, an energy twofer. Exxon, Chevron, both reporting Q3 earnings tomorrow, and that's before the open. Chevron turned in record earnings in Q2. The consensus EPS estimate calls for Chevron at $2.96 and revenue of $61.44 billion. Astounding. Exxon, meanwhile, has an EPS estimate of $3.80 on revenue of $102.96 billion. Jefferies earlier this month upgraded the stock to buy from hold. As for oil prices, on the move ahead of the report, WTI up less than 1% to 88.55 per barrel. Brent also up less than 1%, 96.53. All right, coming up right here, if you're feeling lucky, then Saturday could be your day. Find out how big the Powerball jackpot has climbed next.
Feeling lucky, you want to head out there and go get your Powerball ticket. The Powerball jackpot now sitting at $800 million. It's the second largest Powerball prize and fifth largest overall U.S. jackpot of all time. The next drawing is Saturday, and if the lucky winner picks the cash option, which most people do, they could walk away with $383.7 million after taxes. Not a bad win in there. Are you going to do it?
I'm of course going to play just
You
so I
always
can
play?
envision the boat. And yeah, it's just the yacht. It's worth it to me to dream
I'm
about
with
my
you.
yacht. Are you going to play?
Yeah, of course.
Please do.
I will. Maybe we'll do a team thing.
Little team thing.
All right, I like
that. Okay, because we're never coming to work again. Sorry, guys. All right, if you win that $800 million jackpot, we've got just the holiday catalog for you. Neiman Marcus out with this annual fantasy gifts guide, and there are some eye-popping gifts here. We're talking about a $3.2 million Cartier tiara or a $333,000 basketball game. You get to play, of course, with no ordinary player. You join former Chicago Bulls star Scottie Pippen. That is quite the giveaway there. Shauna, you went through this catalog. What do you want from me when I win the $800 million?
What do I want you to pick?
What do you want me to buy you?
Oh, to buy me. Okay. I would like you to buy $295,000 Polo Aspen experience. I have never played polo. I always thought it looked really cool. It's way too fancy for me, but if I'm winning the lottery, I'll be spending $295,000 maybe on this. When you take a look, it includes one-on-one lessons with 2 polo champions, 2-night stay at the St. Regis. You get to bring 11 friends. Not too shabby.
11? Do I make the cut?
Yeah, you'll make the cut.
I appreciate that.
Of course. The more the merrier. What about you?
Well, you know, I'm a sports guy, so mini golf, custom mini golf course in your backyard, 200 grand seems...
There is no way. I was actually waiting to see if you were going to pick this. I thought you were going to do it given your sports background, but no, there's a much better one, and I think we have it ready for you. Barbiecore. You love Barbiecore. You're trying to convince your wife that you guys could dress up as Ken and Barbie for Halloween. She rejected it. This Maserati, I think, has your name all over it.
I look good in that Maserati, right?
You
really
do.
highlights my nail polish, perhaps. 300 grand, I think that is. I'll get you the diamond tiara just for kicks.
Oh,
okay?
thanks. So sweet of you. All right. Well, that does it for us today on Yahoo Finance. There we go. We'll leave you with that. $3.2 million. That's incredible. All right. Well, that does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a good night.
サントリーから新発売、大人の男性向けスキンケア。顔の印象が変わる10日間始まる。
つい鏡の前でにやけてしまいます。恥ずかしい。触り心地も良くて毎朝おーってバロンいいじゃんって。
顔の印象が変わる10日間始まる。サントリーバロン。
Markets and Dietrich. Ryan, great to have you here with us this morning. All right, first and foremost, we just got to get your perspective on what we've been discussing more broadly here in the Fed and its comfortability in kind of spurring a recession, and how deep, long, or protracted do you believe that recession could be?
You guys want to start off with something a little easier? No, good morning. Thanks for having me. I mean, listen, I think the Fed is hinting that they'd be okay with a mild recession. And although we don't think we're in a recession right now, you don't have 3.5 million jobs created in a recession, in our opinion. The truth is, again, things are clearly slowing. We all get that, right? So 9 months from now, we might be in a mild recession. You look at it though, historically, the Fed hikes until the Fed's funds rate's above CPI. Right now, that's 3.25 versus 8.3. So there's still some room there. We still think inflation is going to come down fairly quickly. I know we had that sticky CPI number, but producer levels, prices paid, chicken wings, there are some things really coming down on the inflation front. But the truth, again, the Fed's seen the history books. Maybe last comment. The Fed's seen the history books, right? It took a double dip recession in the early 80s to stop that runaway inflation. We don't think we're going to necessarily need that, but they know you might need something besides just hiking rates, and that could be drastically slowing the economy, maybe to a mild recession, and that could be kind of what stops inflation. And honestly, guys, the stock market's pricing in a mild recession as we speak, down 24%, maybe making new lows for the year on the S&P as we speak today. That's pricing in at least a mild recession. So from an investment's point of view, there are potentially some positives.
Ryan, thanks for the hot tip on chicken wings. Though, I may not be able to open a home, but I'm going to go buy those in low and just store them in my freezer in my plate, because that makes a lot of sense to me. But look, I'll push back on this. I think this market is starting to now price in more than a mild recession. We are looking at potential testing of the June 16th lows on the S&P 500 around 36, let's say 3,600. And then the floodgates open after that. You can see the S&P go below 3,300. Is that a reasonable scenario if we start getting some really bad economic data?
If we start getting really bad economic data, it's possible. And let's not forget, 3,500 is actually a 50% retracement of the entire bull market. So that's a really big kind of number to be aware of, 3,500. But again, you talked about it, Brian. Like, it's pricing in some bad stuff, right? Look at that AAII sentiment poll. I know you guys talked about it. More than 60% bears last week. Only 4 times in history. All right, and near major market lows, like every time that's happened. So again, everyone's thinking all this bad stuff's out there, and trust me, we're aware it is. When you look at bonds down 14% for the year and stocks in a bear market, this is like the worst year for a 60-40 portfolio. Only once was it worse in 2008 when stocks dropped 40%. So it's a terrible year for investors. At the same time, so much bad stuff is being priced in. When you look at all these sentiment polls and things, I would like to see the VIX a little higher. I would like to see put the call ratios a little bit higher. But again, last comment, October's a bear market killer, right? 84, 94, 98, 2011. For whatever reason, October tends to be a bear market killer. We'd just be open to the idea that could be happening potentially once again this October, the tad more weakness, and then that seasonal strength around a midterm election into the third year of a presidential cycle, especially under a first-term president. That third year usually does really well. I think investors should be thinking about that at least.
Is a defensive portfolio the only play right now? Is there some other type of strategy that investors can employ?
Yeah, well, good point. I mean, with stocks down this much, we think, a little defensive, your utilities and staples, but honestly, start looking at some of those cyclical areas, right? Your financials and industrials. I mean, I know they're down a lot and they've underperformed, but honestly, financials or industrials are starting to do a little bit better. So we think kind of that barbelled approach right here for an investor makes sense. If you all in defensive right now, it's what everybody else is kind of doing. And again, look what happened last week, right? Energy's been doing awesome. Energy was down 9% last week, right? I think one of the things you need for a major low is to shoot everybody. And honestly, now that they're shooting energy and some of the previous leaders, that could be a good thing to finally make some type of a major market low here.
At what point, Ryan, do you jump in and buy big cap tech? I mentioned Apple at the top of the show. It is now leading this market low. Microsoft down over 11% in the past month. Apple down 9%. These are huge declines in household names of companies that are still showing double-digit sales and profit growth, impressive cash positions. Is now the time to jump in, even under the assumption that maybe we lose another 5% here?
Yeah, I'll tell you what, Brian, we don't really like large cap tech here. We're still underweight that group. We think some other areas, we like small caps actually. I mean, we think small caps could do a little better than large caps going forward. At the same time, for somebody who's looking at a 1 to 2 to even longer term horizon, there are some incredible companies you just kind of talked about there making a lot of money that aren't going anywhere. That again, if everybody's thinking alike, somebody isn't thinking. That's the quote I like to use a lot from Patton. A lot of people don't want to touch anything here. So maybe there's some opportunity, and some of those can still do fairly well longer term. We're not too warm and fuzzy tech in general here, honestly, still.
Carson Group Chief Market Strategist Ryan Dietrich. Ryan, always a pleasure to get some of your insights, especially kicking off a new trading week here. Thanks.
Thanks, guys.
この辺のグッズもサトフルだよ。サトフルに囲まれてサトフルいただいて。
俺最近もう豊本んちがふるさとって思い始めてる。
言い過ぎだろ。
さっきもただいまって言ったし。
いいの？
ふるさと納税を始めるならサトフルで。
Dallas Cowboys owner Jerry Jones has taken his investment strategies outside of the world of football, seeing a more than 300% return on his now 182.2 shares of natural gas producer Comstock Resources since 2018. Jerry Jones and Comstock Chairman and CEO Jay Allison join us now live from the New York Stock Exchange. Yahoo Finance's Josh Schaefer is also with us. Good morning to you both. Jerry, I'll start with you. Why did you make this investment in 2018, and how confident are you in the outlook for the company moving forward?
Well, I deliberately went to where the gas was, the Haynesville gas. Comstock had drilled more Haynesville gas wells than anyone. They had initiated the play when it first started years earlier. But it was an opportunity in my mind to get involved with the ability to export natural gas liquids, LNG, the ability to do that. Then I wanted to saddle up with the people that knew it the best in the Haynesville. I made an investment that initially of about $600 million, and then I came in behind that with an investment of about $475 million. The more I found out about Comstock, the more I wanted to put in it.
Jay, it's been a good year in the energy sector. I mean, it's been the best outperforming sector at this point in time. So even as you think about the gains that the share price may have seen, how do you think about the future moving forward from here, and where you may have to continue to invest in order to grow out the business even further?
Well, I'll speak as an investor. The Comstock can differentiate itself from the idea of a energy company. Comstock has very unique reserves. They are, the acreage is where the ethos of the people that do the work, they're generational in being in the oil and gas business. The laws let you put in pipelines, and they let you take it a short distance to the Gulf, where you want the gas to be. And so we have a huge butane tank, if you will, of supplies that frankly, in and of itself, could knock a big dent in what you're selling, what Germany needs. It's that kind of size. So I'm excited about where we are in this current time of investors looking at a natural gas company, where its place is in the energy world, and I'm excited about our management team we have at Comstock.
Jay, you've spent a lot of time in this industry, and we still might see economic growth slow into the winter season. Perhaps we might already be in a recession. Who knows? What does that mean for the outlook for natural gas prices?
Well, I'm not going to get into, because I don't go there, really in analyzing seasonal trends. I will say this, that we all understand that weather and climate help influence gas prices. And we understand aberrations, catastrophes, those kinds of things. But I look at this long term. These reserves that Comstock has can make it go at $2 gas. We can make it go at the different ranges of whatever gas is. It will, though, be there without debt, without loading the company down with debt, so that we will be able to manage through low prices so that you can basically be viable and have the gas for the complete spectrum of demand. Gas is about delivery, not about reserves. It's about delivery. And Comstock is in the place to take huge reserves and get it delivered to the market at the lowest cost in the industry. That's why I'm here.
You know, when Jerry called, he asked if we drill a well, can we take it to sales? And if LNG has legs, can we deliver it to the LNG shippers? And then, do we have inventory? I think the one thing that the M&A world is doing, they had to really grow, even recently, because they had a lack of inventory. If you look at what Jerry did in 2018, he consolidated his private company into Comstock, and then we were aggressive in M&A in 2019. That's when gas was $2 and $3. To be aggressive in M&A when gas is $6, $7, $8, $9 we think goes against our plan. So what we have today, we've got the lowest cost producer with the highest margins, with we think the greatest inventory. We drill about 80 wells a year. We turn about 58 of those to sales every year. So we have about 25 years worth of inventory. So it's pristine and the cost structure is extremely low. I think we got the lowest G&A in the whole sector. And if you just look at sheer cost, it takes us $1 to run the company. And our historic finding cost for 3 years, our numbers, is about $1 to find and develop these reserves. So anything over $2 is a profit for Comstock. Our EBITDAX margins, if you compare them to other oil companies and or gas companies, they're 85%. I mean, these are the highest of the high. So that's what we have. And gas prices will fluctuate. But I do see natural gas, it's taken a detour from where oil is, and it's probably trading at a 10-to-1 now ratio. So it's important. I think it'll be important in the future. They predict by 2023 that the demand for natural gas will probably be greater than oil. So we'll see. As Jerry said, we're sitting on some tremendous gas reserves, and most of that is held by production. 85% of what we own, we do not have to drill. So you put a rig or two out there if things get really tough, and we're still in tremendous shape, particularly
Well, and Jay,
sheet.
I want to interrupt you because he and 2 or 3 other of his management team just bought $5 million worth of stock in the last few days. Now, of course, I sit here as someone who's put over $1 billion in the stock in this company. I've always believed put your money where your mouth is. And what you're seeing is the people that are in the weeds, the people that are seeing the future both on a microscopic level as well as a broad picture are putting their money into Comstock.
So, well, Jerry, to Jerry's point,
just to jump in very quickly, Jay.
$5 or $6?
Yeah.
Yes.
Just to jump in very quickly, Jay, I just wanted to follow up on what Jerry just said. Jerry, would you be willing to take more of a stake in Comstock than you already have? And what threshold would that look like to you?
Absolutely. I have been ready to buy more of Comstock since the day I got here. We manage that way if necessary. What's ended up happening, though, is that we have delevered our balance sheet, and because of the gas prices, and we are sitting here today internally. And so we really can develop these reserves. We can figuratively double our gas production and do it all internally. We don't have to go do issue stock. We don't have to go borrow a lot of money. We can do it internally, and that's what makes Comstock so special.
And Jerry, we can't have you here without asking. Sorry, Jay, I was going to cut in and ask Jerry a little bit about football here. I wanted to ask you a little bit about the Cowboys.
Football.
We know you're here in New York because you got the Giants game tonight as well. The Cowboys are playing the Giants. That game's going to be on ESPN, of course, Monday Night Football. But there has been a lot of talk about what Amazon's doing with Thursday Night Football. I'm curious just what you make of Amazon's interest in the NFL, and what does that mean for the NFL as a whole to have these big tech giants that now want to come and get involved with you guys with Amazon and maybe even potentially Apple down the road?
Well, I think Thursday night's audience was epic. Frankly, deserves special notice by a lot of factions. Those numbers were surprising to me, and I think they're a picture of what's to come. I don't believe there's any question that the game has the interest and has the eyeballs. We're at the right time of the year when you want the decision makers in front of the screens in the fourth quarter. I think all of that's alive and well. Frankly, the picture for the National Football League in the entire time I've been associated with it has never been better because of the continued interest. And then again, you look at last night. Look at how these games turned out last night. 6 or 7 of them decided just with minute to go or with a point difference, that type of thing. All of this points to real eyeball interest, and that's a big deal for the NFL.
And Jerry, you say the picture's never been better, right? We've talked a lot about valuations on this program as teams have been sold. The Broncos were sold for $4.5 billion. I know your valuation, according to Forbes, has basically doubled in the last 5 years at about $8 billion now. I mean, what do you make of valuations? Do you think those numbers are the right numbers? Do you think they're going to keep going up? Do you think the Cowboys are worth more than $8 billion anyway?
Well, I know that I wouldn't sell the Cowboys for 10. I'll book it. I would not. Of course, I'm not interested in selling the Cowboys. And therein lies a part of the answer. You have limited owners. You have limited teams that might ever be available. And you have outstanding growth in those franchises. And then you have the fact that I bought the Cowboys not to make money at all. I had a little money. I'd done it in the gas business. I had a little money, but what I wanted to do was coach football. I never thought that I could be involved in something that would have economic viability. The fact that it does have economic viability and has for the last 30 years, beyond anything I could have ever imagined, is just a major plus. So I think there is a future of values that will exceed what Denver went for sure.
Is there another big player you'd like to add to the team, Jerry? I asked this from a Philadelphia Eagles fan perspective. I just want to sense a landscape of the competition out there.
Well, I'm impressed with the Eagles team, period. And
thank you, Jerry.
I love the way the quarterback has evolved. And I'll tell you this right now, this is really going to seem funny to you. I actually like Eagle fans because they are so passionate, they're so mad at it, and it just tickles me to death to be involved with them up there. And they're all frauds because they're pretty good people behind that hate that they have when they get on the football field.
I had to bring some of that Eagles energy to New York. That's why I moved up here, Jerry. Great to see you up here in New York as well at the New York Stock Exchange. I know you'll probably be at the game later on today, too, between the Cowboys and the Giants. Also, thanks to Jay Allison, Comstock Chairman and CEO, alongside Yahoo Finance's Josh Schaefer. Appreciate the conversation this morning.
With week 3 of the NFL season all but in the books, let's bring in Needham Company Managing Director Bernie McTernan to break down the betting landscape thus far into the football season. Also with us is Yahoo Finance's Josh Schaefer. Bernie, a lot of some big upsets over the weekend. A lot of people maybe counting their losses.
Yeah. Well, so we estimate that was probably a normal hold for the sports books this past weekend. Wasn't necessarily great for my wallet, but yeah, with the Bills, with two of the most like team, the Bills and the Chiefs going down. But overall, we think it was a normal hold for the sports book. The other thing that's hitting as well too is the unders. That's been hitting at a higher than 60% rate, actually pretty similar to last year. But what we focus on and what we think matters the most is the 5 highest spreads. And back to week 1, over the first 3 weeks, the favorite has won 3 or 4 of those, depending on the week. And so that generally points to a normal hold for the operators. So that's in line with DraftKings guidance. And then if we look at a company like Genius Sports, it's actually ahead of or better what they expected. They assumed a hold similar to last year, which was a headwind for the industry. Genius, as you guys have been talking about, is dealing with FX headwinds, but at least the game outcomes are better than what's contemplated in their guidance.
And as far as other numbers that you're looking at is where gamblers are going, right? What platforms they're using. I know you pointed out in your most recent note that DraftKings have been the most popular app on iOS. I was curious if that was surprising at all compared to maybe FanDuel, which I think we understand has more market share nationwide. Is it surprising at all to see DraftKings there? What do you think's driving that?
Yeah, no, it's pretty consistent with last year. If you look at the iOS App Store, DraftKings and FanDuel are really in that top tier together, really jockeying for that 1 and 2 spot for the top sportsbooks app in the sportsbook section of the App Store. And then MGM is really in the 3rd category, and that's followed by Barstool and Caesars below it. And that really held true for most of last year too. The one difference was when New York launched and Caesars made a big marketing promotion to really try to take share in New York. Caesars actually went up to the #1 app, but that was short-lived. If you look at after the NFL season and the NFL preseason, they went back to that number 4 or 5 range where they are currently. So it really seems to be shaping up the way it was last year. And that's a big investor question we get, is what the long-term market share of this industry looks like. And we continue to think DraftKings, one of the reasons why we have a buy rating on the stock is that we think that just their scale begets better technology, which could be a differentiating factor and a reason why customers keep returning to the platform.
And when we talk about the stocks themselves, we like to talk about spending, right? And promotions that these different companies are kind of putting out there. Is DraftKings promoting more than, say, a FanDuel? How are you evaluating the promotions through the first couple of weeks, and who's maybe promoting the most, and how's that kind of driving the market share?
Yeah, look, it's a great question. We have $800 million of an EBITDA loss this year for DraftKings, that peaking in the 3rd quarter with over a $300 million loss. And a lot of that spending is going on sales and marketing. In general, the promotional environment seems a little bit less intense than last year, especially because of the Caesars I spoke about before, how they were really intense with the New York launch and then faded back. Really, but DraftKings and FanDuel, they've been saying that they're going to keep spending against their thresholds. So with DraftKings, that's a 2 to 3 year customer payback on gross margin. And they, both of those companies haven't backed away in terms of how much they think they're willing to spend. DraftKings thinks they have enough cash on their balance sheet to be investing and acquire customers in the same manner they are now to eventually get to profitability in 4Q of 23. And we think full year profitability in fiscal 24. So no real change from the top two. It's just more Caesars. I think we're seeing them back off a little bit relative to the peaks of last year.
Finally, Bernie, from an investment standpoint, where do you see the biggest upside? I mean, which one of these companies offer the most value for the price it's trading at?
Yeah, I mean, frankly, there's 3 companies that we have buy ratings on that I would suggest here: DraftKings, Penn, and Genius Sports. On DraftKings, it's really for the investor that's willing and able to take that 2 to 3 year time horizon, when you're able to look at 25, 26 EBITDA, put a multiple on it, discount it back. With Penn, they're generating profitability now. They have the core regional casino business, but even their interactive segment, it's only going to be a $50 million drag this year. The core US is going to be at least break even. And we think that that's a unique opportunity to play this space and really leveraging that convergence between sports betting and sports media. And then lastly, I mentioned earlier with Genius Sports as the data provider, and really they're using their data contracts to create other businesses. So if you're watching Prime Video on Thursday night, and you'll see that Prime Cast, the alternative broadcast. Well, a lot of that is powered by Genius technology. They also have a ad serving capability where they're helping sportsbooks acquire customers. So really leveraging that data relationship with the leagues and the sportsbooks to create a whole nother or other revenue streams about it. So those are the 3 picks that I would highlight in the sports betting landscape that we're bullish on.
Well, Bernie, here's hoping for a better week 4, maybe for your wallet. Bernie McTernan, Needham Company Managing Director. Always good to have you on the show.
Thank you, team. Thank you. Today is indeed a historic day. We are at the beginning of a transformational journey that will have an impact for generations to come. Transformational for Micron and our capabilities to create leading-edge memory. Transformational for Central New York as together we build a world-class semiconductor hub. Transformational for the United States and the world, driving a renaissance in advanced manufacturing, securing our future, and building technology solutions that truly will enrich life for all. Thank you. And now, thank you.
Your summer utility bill sent a shock through your
And
wallet.
now it is my honor
brace yourself for
to
more
invite
high
President
prices
Biden
come
to
winter.
come back to
Some
the
estimate
podium
households
to
could be
make
paying
no
up to 25% more to heat their homes this year. Joining us now is John Bartlett. He's president of Reeves Asset Management. John, it's good to talk to you today. We just said 25%. I've seen some estimates that put it at about 35%. How painful are things about to get?
Well, I think we're going to see the worst of it this winter. That's the good news. It is. It really depends on where you live and how you heat your house and how your utility generates its electricity or buys it on your behalf.
My grandfather's.
And John, talk to us a little bit about the impact of natural gas on utility companies today.
Thank you all so very much.
Sure. Well, you know, natural gas is the fuel that sets the price of electricity. The last generator that comes on is usually a natural gas facility, and that's the one that sets the price. Generally speaking, your utility is buying natural gas either to fire its own generating stations, or it's buying natural gas for you to heat your house. They're buying it all year long, and when we get to the winter months, roughly half of the gas that you're burning in your house is coming out of storage, and that gas obviously was bought much earlier on in the injection season.
Yeah, so what's actually driving these prices to these levels? Is it a simple supply-demand dynamic?
Yeah, well, in this winter, it's just simply that, and it is something that is, you know, as you can imagine, the best thing for high prices is really high prices, and we're seeing that at work right now. That is the confluence of supply and demand really adjusting to a little bit better sense of equilibrium.
So how should investors play the utility space? Because I'm taking a look at our Wi-Fi Interactive board, our charts for the sectors. XLU is down more than 1%. Outperforming, though, the broader markets, as you're looking at the S&P down year to date, 22%. XLE, of course, is the major one that's gaining this year. But so how should investors play this? Do they continue with utility stocks if they're in these, or do they sell and take some profits off the table?
Well, you know, I think as far as utilities go and their relationship to the rest of the market, what you see is what you get. And what we've experienced this year is significant outperformance, really on the backs of the fear trade and also a fundamental improvement in the industry. And that's not insignificant. Generally speaking, if you
YouTube プレミアムならお気に入りの動画を一時保存したりバックグラウンド再生が可能広告なしの動画が楽しめ YouTube ミュージックプレミアムもついてくる自分だけのミックスリストや幅広いジャンルの楽曲を心
What's been very constructive regulation, not only at the state but also at the federal level, utilities have had a good run, and I think what you can expect is your dividend yield plus your earnings growth on an ongoing basis. There are some PEs that are probably a little too high, and there certainly aren't any places to go bottom fishing in utilities. But again, I would go back to my earlier comment. What you see is what you get: earnings plus dividend, and a very strong outlook.
I mean, is this sort of similar to what we've been seeing when oil and gas companies? I mean, oil companies, we're talking about natural gas here, but, you know, we've seen the profits go up on the back of consumers who are the ones that are having to pick up the load, and yet it's been incredibly profitable and good for investors too. I mean, is that sort of how investors should be looking at these utility names as we go into the winter months and look at these major price hikes?
No, I don't think so at all. All of those companies profit on higher commodity prices. Utilities really only have their fortunes based on solid regulation and the investments that they have in their companies. So,
Syracuse University, where I studied psychology, which is totally different from what I'm doing now. But I got my start as an electrician, doing an amateur rough-in with my dad in Florida, and I loved it. I enjoyed the experience, and so my dad told me, if you love it so much, when you get back to New York, you join the union. And so that's what I did. Local 43, they welcomed me, and with some borrowed tools from our now business manager, Al Marzullo. Ooh, Al. I was able to work my way up, starting as a helper, moving up to being an apprentice, and then a journeywoman electrician. And now I am the first Black woman master electrician in the region. My career as in the IBEW changed my life for the better. It's given me incredible opportunities and a bright future here in Syracuse, New York area. And I'm not only a master electrician, but I also own my own electrical contracting company, Luminary Electrical Contractor. And we are here and we are ready to power up New York's long-awaited manufacturing rebirth. So needed. So you all can only imagine how much of an honor it is to be able to introduce the President of the United States. When I got that call, I was like, who? Anyway, we all know that politicians tend to make a lot of promises, especially during election season, which we have coming up. And too many of them don't actually keep their promises, but not President Biden. One thing I really like about President Biden is that he understands the value of our workers in the United States, and that we've always, as workers, stepped up to help our communities and our country, and that the workers of this country should be respected, and as well as the unions in this country. Excuse me. So he made some promises when he got elected, and I remember some of these promises. They're written down on this paper here, so let me go ahead and read those. He promised to reach across the aisle. He promised to invest in rebuilding and modernizing our infrastructure, to expand our broadband, modernize our grid for cleaner energy, and to target underserved communities, excuse me. President Biden promised to bring back manufacturing so that we can start building things in this country again. Well, here we are 2 years later, and I am saying loud and proud that promises were made and promises were kept. People that have lived in this community, myself, my whole life, we understand how desperately we need this new beginning in the Syracuse and Central New York area, especially with all of the plants closing, job losses, and the hearts breaking for generations of workers. So this plant means hope. It means good paying, union, construction, and manufacturing jobs for years to come. So selfishly, I'm really excited about this. This plan also means that when I go to see and speak to our high school and middle school students, I can, which is our next generation of workers, I can look at them and say, you can get a job right here in Syracuse. You don't have to go away anymore. You know, that was one of the things that we lost, with a lot of people moving away because we didn't have that. So we have that now, and I'm able to go ahead and say that to them, right, looking right in the eye and say that to them, and also to show them that a person that looks like them can be a part of rebuilding our city, our state, our country. And call ourselves union members and a CEO. But it's not just about the announcement today for what we're here for Micron, but thanks to the bipartisan infrastructure law, Central New York is rebuilding just along with the rest of the country, excuse me. Hundreds of local 43 brothers and sisters are already working on the massive I-81 reconstruction project, thanks to President Biden and Governor Hochul. And Joe Biden's always kept his promises to union workers like myself, and that's why I'm proud to be standing here today. So on behalf of my family, on behalf of my local union, on behalf of this great city of Syracuse, New York, it is my greatest honor to introduce a great champion of American workers that we've ever had in the White House. All right, ever. The 46th President of the United States, President Joe Biden.
Thank you very much. Hello, Syracuse. If you have a seat, take it. If you don't, I'd probably leave. Shawnee, thank you for that introduction and for representing your sisters and brothers at the IBW. One of the reasons I'm standing here is because of the IBW, not a joke. They endorsed me early on, and along with, quite frankly, every other union in America, and we came along. I made a promise, and I'm keeping it. I'd be the most pro-union president in American history, and I'm going to make sure that happens. Simple reason for that. You know, the middle class built this country, and unions built the middle class. We used to say in the Senate, excuse the point of personal privilege, so I'd like to introduce some of my family and friends, and I don't know where they are right now, but my, you know, I married a beautiful woman from Skaneateles Lake, was at Syracuse. I met her on spring break and fell head over heels in love with her, and gave up a starting job on the football team in Delaware to come up every weekend because I couldn't stay away from her. And her brother Michael's here. Where's the family? There they are, back here. The Hunter family. The Hunter family is here. Carter Moore and Greg and the children, Killian and Gregory and Nancy Hunter and her daughter Jess, my brother-in-law Johnny's wife and daughter, and as well as one of Bo's best buddies, Andy Grove, an old friend who's here. I excuse this again, as used to say in the Senate, the point of personal privilege, but it's like coming home, man. for coming home. Molly and her brother, Jimmy Crean. And the president of Syracuse University and the dean of the law school, who probably I wouldn't get in these days, although I went there on a scholarship. And Mayor Walsh, Ben, thank you, County Executive McMahon. It's good, it's good to be in a place that means so much to me, and that means so much to our country. The project and the celebration. Governor Hochul, thank you for the passport into the state. Appreciate it very, very much. You've been a great partner to me and a great leader for the state. You saw an opportunity to attract more semiconductor supply chain businesses, and you signed a law to make New York even more welcoming. We were down in Poughkeepsie not long ago, a little outfit called IBM, spending $20 billion investing in incredible jobs, attracting companies, creating jobs. A century ago, this region was the heartland of manufacturing. And when I was up here as a law student, you had Kodak, Corning, General Electric. Governors always believed it could be that way again. She thought that would be the case, and the region is poised to lead the world in advanced manufacturing. Not a joke. Poised to lead the world. And I also want to thank my buddy Chuck Schumer, Senate Majority Leader. This guy gets things done. Close to a hometown girl, a senator from upstate New York, Kristen Gillibrand. She gets things done. I learned a long time ago, when Kristen calls and asks something, just say yes. Just do it right away, because you're going to do that anyway. And look, it's a hell of a delegation. I think it's one of the best delegations in the country, and Chuck is a great majority leader. Getting big things done. We wouldn't be here today. It's not hyperbole. We wouldn't be here today without him. And Kristen's, as I said, hometown here in upstate New York. She's a fighter for families in this area. And you'll be hearing from all these folks in a minute. Congressman John Katko. Where's John? Johnny? Stand up. John is a Republican, and I like him a lot. John, when I've been in the Congress for a long time, and we used to have, this is how we used to be. We used to work together like you work together. And with the delegation, thank you very much. I'm quite frankly a little sorry you're leaving. And thanks for what you've done. And thanks for the passport in your district. I appreciate it. And thanks for reaching across the aisle to support the CHIPS and Science Act, which this guy wrote right here. You know, and we also have one of the leading members of the United States Congress, chair of the House Intelligence Committee, Adam Schiff. He came all the way from California just to see Chuck. Where is he? There he is. Good to see you, Adam. Adam and I talk together a lot. We can't share any secrets. He's the only guy who can talk to. Folks, we're here to celebrate one of the most significant investments in American history. Again, not hyperbole. The most significant investments in American history. And it's going to ensure that the future is made in America. One of the bright spots around the country that should give us a sense of optimism and hope about who we are as a nation. And it's part of a broader story about an economy we're building, one that works for everyone. Positions America to win the economic competition of the 21st century. And again, that's not an exaggeration. It's literally an accurate statement. We're joined today by the CEO of Micron to celebrate their commitment to invest $100 billion over the next 20 years here in America to build factories, to make semiconductors, or small little computer chips that power everything in our everyday lives, from our smartphones to our automobiles to washing machines, hospital equipment, you name it. It's the largest American investment of its kind ever in our history. Thank you very much, Paul. They're going to build factories, size of, this is not hyperbole, the size of 40 football fields. Big enough to fit the Carrier Dome 4 times inside it and still have space left over. And this is amazing what's going to happen here. You guys have no idea. It's going to run, and it's going to run entirely on renewable energy. 9,000 jobs, from PhDs and engineers, HVAC technicians, machine operators, with an average salary of $100,000 a year, and tens of thousands more jobs across the supply chain. 20 unions working together to build jobs for technicians, construction workers, electricians, operating engineers. And by the way, it's the largest investment in American history that's also governed by a project labor agreement. That's a fancy way of saying union. Union, not labor, union. They ensure that the major projects are handled by well-trained, well-prepared contractors, subcontractors, and highly skilled workers. These agreements make the construction a top-notch project because they're the best folks to do it. Their projects are on time, on task, and on budget. Back in February, I signed an executive order to make sure large federal construction projects use project labor agreements. And it means that Micron is using one here as well. Micron's also paying the prevailing wage for funding apprenticeships programs, so folks can get trained in places like this community college for one of the thousands of good-paying jobs in this new site. And it really matters. It matters a lot. America invested in these chips. The federal investment helped reduce their costs, creating a market and an entire industry that's American-led. You know, that's how it all started. As a result, over 30 years ago, America had more than 30% of the global chip production. 30%. Then something happened. American manufacturing, the backbone of our economy, got hollowed out. Companies moved jobs overseas, in the industrial Midwest, as well as from the Northeast and manufacturing towns like here in central New York and upstate New York. And as a result, today we're down to producing only about 10% of the world's chips. We invented them, but we produce only 10%, despite leading the world in research and design of new chip technology as well. It's here in the United States. But because of the new law I signed and Chuck designed and delivered, we're turning things way around in a very big way. And with Micron's $100 billion investment alone, we're going to increase America's share of global memory chips and production by 500%. The company Intel in Ohio and other companies, including foreign companies, that are investing billions of dollars across America to make these chips here. And it matters to you all. No matter where you live, it matters a great deal. Making these chips in America is going to help lower the cost for families looking to buy a car, to replace your washing machine, get a new cell phone. It also helps companies outcompete the rest of the world. And I've heard from Xi Jinping that he's a little concerned about that. No, I'm not joking. It's not, as I told him, it's not about conflict, it's about competition. We're back in the game. We're competing again in a big way. Think about it this way. IBM needs these chips to build the fastest quantum computers ever built in the world in Poughkeepsie, New York. Instead of relying on chips made overseas that could be delayed because of a pandemic or some other global supply chain issue, they can get their chips in a few hours. It's a game changer. You know, where is it written? Where is it written that the United States of America can't be the manufacturing capital of the world? Think about this. No, I mean it sincerely. Where in the hell is it written that says we cannot be, as we've been hearing for the last 25 years, the manufacturing capital of the world? This country lost over 180,000 manufacturing jobs under the last guy that had this job. We've created 700,000 manufacturing jobs on my watch, adding manufacturing jobs at a faster rate than in 40 years. previous president made a string of broken promises in places like Wisconsin, Indiana, Ohio, where promised investments in jobs and manufacturing never materialized, but layoffs and shuttered factories did materialize. On my watch, we've kept our commitments. On my watch, Made in America isn't just a slogan, it's a reality. Made in America. Today's announcement is the latest example of my economic plan at work. I've said from the beginning, my objective is to build an economy from the bottom up and the middle out. An economy that rewards work, not just wealth. An economy that works for everyone. So the poor have a ladder up, the middle class can do better, and when that happens, the wealthy do very well. They don't get hurt at all, they do very well. It's a fundamental shift, and it's working compared to what the very conservative Republicans are all doing. Let's just take a look at the facts. When I took office, the economy was in ruins. My predecessor was the first president since Herbert Hoover. Not a joke to lose jobs in the entirety of his administration. First, unemployment when I was sworn in was at 6.4%. Hundreds of thousands of small businesses closed. The irony is that during the pandemic, the record number of Americans became, at the same time we lost all these small companies, the record number of Americans became billionaires in the middle of this crisis. While more than 9 million people are still out of work from the pandemic when I took office. Today, with the help of the people behind me, we're in a much better place. 10 million jobs created since we took office.
Come through economic growth. There's no real challenge to how they're going to spend money. And so basically there's been a loss of confidence in the gilt market in sterling. So that's why we've seen the collapse there.
知っていましたか？実は暖房で温めた熱は大部分窓から。
And for multinational companies who are watching this happen, what do they need to be keeping an eye on right now?
Well, yeah, you have to think about how these three factors work together. We've got the global growth dynamics, which are quite important. You have to think about what's happening in China. Again, we still have the zero COVID policy. We're on and off in terms of whether or not things can grow there. What we have is basically Asia and China in general is trying to ease financial conditions. They're cutting rates. They're trying to stimulate growth. They are dealing with low inflation. In the US, it's different. The US is they're trying to tighten financial conditions. They're trying to raise rates. They're trying to take some steam out of markets in general. And in Europe, the financial condition shock has been imposed on them, again, by these forces related to the cost of energy and electricity and the terms of trade shock. So I think what investors need to kind of keep their eyes on is really all the world's most important regions are divergent. And the way that the world kind of absorbs these shocks is through the currency market. And that's why there's so much volatility. This is why currencies are doing different things in different regions. But the key thing in the very short term to keep your eye on is we have an inflation report coming up. That's going to be very critical. We had a very good inflation report, then we had a very bad inflation report. And now we've seen, again, a pivot in the Fed's relative hawkishness, which kind of, dovetails with what we've seen in the latest report. But if we get an inflation report that's a little bit more benign than market expectations, we might see some pressure come off in the very short term. But again, for the next 3 to 6 months, we're still dealing with a challenging global growth environment. We're still dealing with persistence in terms of figuring out where central banks stop in terms of their terminal rates. And then lastly, again, this ongoing terms of trade shock is not going to dissipate through the winter unless we get very lucky and have a warm winter in Europe.
Mark, it doesn't seem like anything is stopping the dollar's momentum, at least right now. What's it going to take in order for us to see the dollar peak?
Yeah, it goes back to the inflation in the very short term. We have these indicators, we call them stagflation indicators. What we're doing is looking at relative global inflation versus relative global growth expectations. dollar's running about a 12% premium, which is pretty unheard of in a framework like that. So if you kind of look at also the correlation of the 60-40 or the risk parity portfolio, the dollar is like the perfect stagflation hedge. You get a little bit of a yield. It's negatively correlated with equities. And so if you have a bearish view on equities and credit, the dollar's a great place to kind of sit there and wait things out. So for things to change, we need to see inflation numbers. And again, I think what people are a little bit too focused on the core numbers, because core is 40% of that is represented through the housing market, which again, the Fed has very little impact on the housing market in the very short term. But I think the things we want to continue to see is the downside in commodities, the slower move in producer prices. Again, the fact that we're seeing supply chain indicator stress start to alleviate are good signs, but we need to see the next inflation report come in line expectations with markets. That'll help cool things a bit. But for the full turn in the dollar, we're going to need to see the global economy start to recover. So we'll need Chinese financial conditions to kick in. We need to see Europe kind of work through this terms of trade shock, which is going to, again, take us through the winter. And we have to see kind of global peak inflation. So those are the three factors.
And Mark, not to put you on the spot, just when we're trying to gauge, I guess, where we're headed from here, 6 months from now, where do you see the dollar?
So I'd say in 6 months, it's still relatively resilient. I'd say if you want to go 9 to 12 months, we have a very big drop expected in the dollar. I think one of the things that people have done through COVID, which has been very challenging, is you're kind of taking these peak extremes that have been pulled in through the pandemic itself and extrapolating. You know, if you extrapolated from where we started with COVID, we would have never seen a recovery in the economy. We saw a massive rebound in data surprises and data expectations through, right after the economy started to reopen. We had a massive reflationary trade because of all the stimulus we got. Now we've seen the removal of the stimulus and some of the normalization. So I think to extrapolate this world, the one we're in now for the next 12 months is going to be challenging. I think the next 6 months, we still have the dollar generally resilient, but I think it's starting to turn over and we're starting to forecast a lower dollar 6 months out. I think if you want to go 12 months, we do have the dollar falling by, the levels of some of the risk premium that's embedded there by 12 to 14% against specific currency pairs.
And Mark, I just want to quickly ask you about the new Italian Prime Minister, obviously Italy, the third largest economy in Europe. What are you keeping an eye on there? And do you expect any shifts as a result of this?
No, it's very interesting that for the first time, Italian politics has taken a back seat on European currency moves to UK-based politics. I think, again, what people are going to be watching here is the BTB bund spread. Is there a lot of pressure? It does seem like a lot of what we've seen from Italy has been a lot of rhetoric, and the rhetoric so far hasn't really matched anything in terms of policies seemed a little bit more tempered relative to expectations. The prime minister was kind of saying the right things. So I think in this regard, Italy's kind of a secondary force. I don't think it's a big driver. I think we knew where we were going. So there's not too much that we're watching there. I think you're going to want to see some of the spots, who's going to be leading the finance ministry and some of these key appointments. But other than that, the market's just going to continue to monitor the BTB and bund spread. But for this moment right now, euro sterling and European currencies in general is really going to be dominated by what's happening in the UK fiscal policy rather than European politics.
In this episode of Influencers, Dice founder and CEO Phil Hutchin, along with Tony Fadell, Dice board member, Nest founder, and inventor of the iPod.
Humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your lives.
There's always unintended consequences in everything, and technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse.
7回転んだら8回起き上がる。最後に勝てばいいのではないでしょうか。
オッズパーク、今すぐダウンロード。
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Phil Hutchin, the founder and CEO of Dice. Also, Tony Fidel, a board member at Dice. Tony, as you may know, former Apple executive, iPod inventor, iPhone co-inventor, also Nest founder, and a principal at Future Shape, which is an investment and advisory firm working with engineers and scientists, developing foundational deep technology, I should say. Got all that. Okay, we want to talk about Dice. And Phil, why don't you start us off by telling us what Dice is all about and what you guys are doing?
Yeah, no problem. And nice to see you, Andy. Well, first of all, Andy, have you ever bought a ticket?
Yes, I have.
And how was that?
Not so good, Phil.
And so I think that every time we kind of ask someone if they bought a ticket, it has ever come back to me with like this, like, oh my God, it was amazing. It was always like, I bought a ticket, I thought it was one price and it was another price, or I couldn't buy a ticket and it was thousands of dollars or whatever it was, or, you know, I missed out on the show, whatever it is. And so there's lots of problems around it and, you know, the opaque nature of the industry. So Dice is a super simple way to find out what shows are going on. 2 taps and you've bought the ticket. You know, it's killed scalping. And if you can't turn up to the show, you tap a button and you get a refund. And it's just making all those things traditionally associated with, you know, going to a live experience, they're gone, and now it's just very easy.
I have a million more follow-up questions, and we'll get to them. But Tony, I got to ask you, you joined the board of Dice in September. What made you a believer, and why join at a time when the live music industry is still getting back on its feet with COVID?
Sure, Andy. As well, it's great to see you. So for me, you know, music's in my blood, you know, given my past, and I'm from Detroit, right? So when I was in Detroit, exactly, you know, Ticketmaster first came out, and it was like a revolution. I could go walk down to a local store and get a printed ticket. You didn't have to go to the box office. And so that was an incredible innovation for me. But since that part, they haven't innovated a lot. It's still like, okay, what can we do to extract more money from the fans, really, is what it is. And it hasn't been about more convenience, about more access, making it easy. You know, you can say what you want about airline ticketing or other travel ticketing. At least you can exchange tickets, upgrade them, change the dates, everything. You don't have any of those conveniences at all in the ticketing, in the entertainment ticketing world or sports ticketing world. Well, that's what Dice is trying to solve. And because I'm such a music fanatic and have been suffering with these things for years, I met Phil, and I didn't just get involved with Dice this year. I've been involved with Phil and Dice, I don't know, 5-6 years now. So this was like literally when they were like 10, 12, 15 people. So we've been working together with them and just been, because of the experience that they really want to bring. Fans first. It's all about the fans. Even the artists, the venues, everyone understands that. More fans, and especially today when, you know, bands are not making any money except for merchandise and for entertainment events. Other than that, they're not making any money on streaming. We see that unless you're the top, you know, 100 artists, they don't make any money. So where are they going to make their money, and how are they going to make sure the fan has a great experience? That's what Dice is all about.
Phil, I got to ask you about the competitive set. I mean, Tony mentioned Ticketmaster. They're still around. StubHub, Eventbrite. What sets you guys apart from those companies, and how are you going to build your brand?
Right. So I think I kind of touched on it. Like, our only customer is the fans, and that was something that we established on day one. So everything that we build is for that fan experience. So when we're building things with partners or venues or artists or anything else, we always ask the question, is it good for the fan? And I think that the second thing is that Dice is just software. So, you know, if you're looking at Live Nation, I mean, they do huge productions, they do all these things, you know, Ticketmaster is part of it. We're just like the you know, using software to bring fans and artists closer together, like helping them, you know, decide which cities they're on, you know, how much they should be charging, all these things to make it super efficient. And I think that the third is that we're able to scale much quicker around the globe. So I mean, we started off in London, but now we're in, you know, the US, in France, Spain, Italy, India, Australia, moving into Southeast Asia. So it's like, it's kind of, there's a global network effect that happens as well, because, you know, you're giving that data to artists to help them plan global strategies themselves. So it's just really, when we're talking about empowering artists, it's like helping them control their cash, that they own the cash. They can pay people and do things instead of waiting for someone to pay them.
How do you mitigate against scalpers? You mentioned that. Can you drill down a little bit more there?
Yeah, cool. So this is, it's like things where in hindsight it's like so simple, but there's nothing to sell. When you buy a ticket on Dice, there's no ticket. And so there's nothing to screenshot, there's nothing to pass on to somebody else or anything else. Just moments before the show, there's like an animated a QR code that goes around, which is there. But it's a very elegant, simple solution. But it's a way that if you've got nothing to sell, then it's impossible for scalpers to put it on any platform because they don't have anything.
And how much of the business, Phil, is reliant upon the return of live music to pre-pandemic levels? And what is your prediction about when that'll happen?
So we've spent 18 months, or give or take, like sort of stuck in our homes, been entirely digital. And you're thinking about one of the things that I didn't appreciate, at the beginning of Dice, and kind of really kicked in sort of just before the pandemic, is that we saw some data in terms of loneliness for people aged between 17 and 21, and a third of them expressed that they had intense periods of loneliness. Even before the pandemic. You put the pandemic on, everyone kind of living digitally. The return to live since summer, it's been insane. Every record has been broken at Dice in the last 5 months. When we're looking at the data, like still now, shows are completely packed, like the venues are packed, everything else. You read in the newspapers that people have become hesitant about stuff, and then you go to live concerts and they're absolutely full. And I think it's kind of going back into what I was talking about with loneliness, that humans need to be around other people. It's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your life. So live experiences, I think that people are actually appreciating them even more as a result of the pandemic.
いい朝から始まるいい一日。取り戻そう自分時間。選べる受け取りスポット。
Yeah, Phil, I've been giving Tony grief about musical preferences. I'm going to hit you a little bit. Like, I don't know if it's Adele or Coldplay. You know, I'm doing the UK thing with you. So do you work with the artists or do you work with the venues? So in other words, here in New York City, MSG, Madison Square Garden, are you selling tickets for them or are you selling tickets for Adele?
So we do it for both, but the focus is largely on venues because many artists play venues. But we have an artist development team, and that's part of the idea of the global network is that DICE has venues all around the world, and then artists want to play those venues, and we help them kind of connect them with those venues via their agents or the bookers or whatever else. And then part of that is, so I've got an example. So it's an artist in London called Valiant. They started off with us from the very first show, 200 people. And we made the deal with them, like, cool, sell exclusively through DICE. Let's kind of like build up this live story. And then from that, you're not allowed to spend any money on social media advertising. You've got to trust into your audience, you've got to get the story right. Now they can sell 50,000 tickets in London. And it's kind of like taking them at each of those steps all the way through. And throughout the whole time, Bicep understood their audience, they knew what they wanted, where they wanted to play. They had control over, their live strategy. And this is what we're doing at scale now.
Right. And so do you cover all the venues in the world, or do you have to, are there some venues that are not a part of your ecosystem yet?
Yeah, so we wish we had, well, we have all the best ones, or most of the best ones. So there's some holdouts, but there's other people who have the ticketing rights for those venues. But we have it's 3,600 venues sort of around the world, which is increasing day by day. And we also work largely in major cities. So the in New York, over 1 million people used DICE last month. And so there's quite a big spread of venues in New York, and for that, it's the same in Paris and Barcelona, all these things, because there's lots of events happening there. So the discovery engine is really kicking off, and our thing is that if you want to see a show once a month, then let's get you to a show once a week. How do we reduce the friction for you to actually get there? So our competition is like people staying at home watching Netflix. Is like, okay, well, how do we make it as easy and compelling to kind of get out and see something? And it works. I don't think anyone's been to a great show and said, well, I'm not doing that again. So it's the exact opposite.
Tony, while I have you here, I got to ask you a few questions about Apple and the iPhone, Silicon Valley.
Oh, God.
So you are on the cutting edge in designing the iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech?
Is like people staying at home watching is like people not doing that again.
iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech? Thoughts on the metaverse? Those are two big questions happening right now.
Well, the big things on the horizon for consumer electronics, we're hearing more about, augmented reality, these kinds of things. We're hearing about the metaverse. Frankly, I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse. So let's make sure we have an environment to live in before we find another environment that, keeps us in like refrigerated chambers and, so that we can breathe and eat. So that's how I feel about the metaverse, but on consumer electronics, I think, a lot of this stuff, people think that this is going to be the next big thing, like augmented reality. I think it will be for certain very niche verticals, but not necessarily like the consumer thing that you need. Because, we saw this before. You got to need the technology, and then you have to understand that the consumers want it, right? And they want to live with these things on it. And it's social acceptance, not just you accepting it, but the people around you accepting it. And that I've learned all the time is the technology might be right, but is the social timing right? Is there a social acceptance? And are you truly delivering a pain killer because there's a clear need, there's a clear pain? The iPhone solved a need, right? It was on the go, internet, email, media, these kinds of things. Well, we don't see the need yet for the metaverse, and then to have the metaverse wherever you go on you, We already tried that with Google Glass. I think it's going to take a little while.
Yeah, and speaking of Google, you helped create the iPhone, the iPod Nest, which was bought by Google, and these products are networked now in a huge way. What is your take on both the upside and the downside of this massive amount of networking that some people say, leads to dystopian possibilities, but also tremendous upside?
Well, look, there's always unintended consequences in everything. And technology is neutral. It's what we choose to do with it and how we regulate and what we socially accept. So we have to do things that promote social bonding, like what Bill's doing with Dice, right? Not letting the ticket bots in there, not letting the scalpers in there, doing all the things necessary. And that's why I love what Bill and Dice is doing, is they're trying to bring all the best things to connect the artists to the fans, right? And getting rid of all of those middlemen who are just stealing along the way. So that's what we want to do. And so I love the network. It can have better shows, have the artists make more things for their fans so that the fans have a better and better experience. And maybe through that, we can create even more social movement to fix some more of these problems. But it's about bringing people together and not about a network of, intermediaries stealing along the way.
All right, just one more Wayback Machine question.
Okay.
Okay. And that's, you worked with Steve Jobs.
Yeah.
Apple built a music business when you were there. What did you learn from Steve, and what do you think he'd be thinking about the world today and the technology that we're using?
Well, I think for me, what it was all about in the music store and the iPod, it was always about, what do the customers really want? What is going to give them that that emotional experience that they crave, that they want, and a rational part of that, making it simple and all those other things. And that's that's like Dice. So when you see something like this, you're like, wow. I think that if Steve was here today, he would go, we need to get artists more money. I think if he looked at the streaming services out there, I know how much he loved musicians, bands, and wanted to support them. I remember way back when he was looking at buying certain media companies, that kind of stuff, because he really wanted to revolutionize that. And so as far as I'm concerned, if he woke up today and saw the streaming services the way they are today and where the artists are not getting fairly paid, he would fix that. Absolutely.
I remember Tony and Phil when he came by and demoed the iPad at Time Inc. when I worked there, and he played music and he played Friend of the Devil. And I said, oh, the Grateful Dead. And he goes, I love the Grateful Dead. You can see he really meant it, right?
Yeah,
He was really passionate about that.
YouTube プレミアムならお気に入りの動画を楽しみ続けられる。オフライン再生したり他のアプリを使いながらでも、画面ロック中でも途切れない YouTube プレミアムで動画を広告なしオフラインで楽しもう。まずは1ヶ月無料体験。
you come from a musical background, a music industry background, I should say. But geez, what made you decide to get into ticketing?
Yeah, I mean, I wasn't tech before going into the music and not knowing anything about the music industry. So very naive, but very lucky in the music industry that found some artists who were getting bigger and bigger, and actually didn't care about ticketing, didn't understand it, because you spend so much time, working with the artists and making an amazing album, to making amazing artwork, looking at their live show. And didn't think about the ticketing until the artists started getting bigger in North America, and that was when I suddenly was like, hang on a minute, we did a deal for $40 and now the ticket's 65. Where's this 25 going? It's sold out and it's been sold for hundreds, thousands of dollars, and all the fans are angry at the artists. Like, why isn't anyone fixing this? And so then I went back into sort of old world, new world together and just analyzed all the ticket companies and tried them all out. Didn't want to, just trying to see if there was a solution. And that was the thing. Well, no one else is going to fix it. I guess that we have to do it. So, and kind of just touching on to the last question as well. I think that take a lot of inspiration from what Tony created. Really thinking about the small things. The experience when someone sees it, small little animations within the app, the ticket, the imagery. You're talking about brand before, like people wear Dice t-shirts and have the bags and everything else. Like all these things are like things which we really care about, because you need to make a revolution, and all this stuff like pays off because eventually, because of all these things being put together.
7回転んだら8回起き上がる。最後に勝てばいいのではないでしょうか。オッズパーク、今すぐダウンロード。
naphthalene leading the way up nearly 2%. In terms of what's lagging, consumer staples and utilities, the two worst performers. Dave?
All right, thank you, Shauna. Let's get you up to speed now on housing, which really right now depends upon your perspective. Some new numbers out from CoreLogic show U.S. home prices in July cooled at their fastest pace in the history of the Case-Shiller Index. Nationally, prices are higher than a year ago and rose 15.8% from July to August. That's a lot, but well below the 18-point increase the previous month. So again, prices are still growing. They're just growing slower than before. Outliers here include Tampa and Miami with stunning increases. Look at that. 31.8 and 31.7% respectively year over year. That is dramatic. And overall, our dire thoughts about the economy brightened a bit with consumer confidence actually improving for a second straight month. Another surprise here. The Conference Board reporting the baseline index rose to 108 from 103 in August. We'll get University of Michigan numbers at the end of the month. And Rochelle, as we toss back to you, we will hear from a Miami broker later in the show to get a better sense of what in the world is going on down there with prices up more than 30%.
That's right. Now, before we get to that, though, we're going to get you up to speed with what's happening with Hurricane Ian and its impact on oil and gas prices. We did see oil bouncing off a 9-month low. You have WTI and crude both up there. WTI up about 2%. Brent crude up about 2.5% there. Also taking a look at natural gas, that's down fractionally. As we can see there, that's down about 2.9%. As you look at RBOB as well, that's actually up almost 5% there, about 4.5%. Now, late Monday, of course, we heard from BP and Chevron. They actually cut production at offshore oil platforms in the Gulf of Mexico and evacuated personnel due to the storm. That affects about 485,000 barrels per day, or less than about 5% of U.S. oil production. But of course, Florida bracing for the worst of the hurricane. Now, it's not a major producer or refiner, which is why RBC Capital Markets analyst Michael Tran says this is not going to be a meaningful event for the global oil market. But of course, you have the domino effect of delayed deliveries due to evacuations, flooding and wind damage, all of those weighing on oil markets that were already under pressure amid broader market losses that we're seeing across the board. All right, well, let's take a look for more on the broader markets. We're joined by Bill Smead, Smead Capital Management CIO. Welcome back to the show, Bill. So I want to get your take on what the markets are digesting right now as we continue to see a choppy day for them.
Well, we call this a nasty bear market because it's a bear market that's designed to cure the sins of the prior euphoria episode. So the punishment has a tendency to match the crime. So you've had a huge set of manias. Charlie Munger, Warren Buffett's right-hand guy, says this was the biggest financial euphoria episode he's seen in his career because of the totality of it. And so what we're seeing now is a rotational bear market that is moving from one inflamed euphoria segment, whether it be crypto or whether it be FANG stocks or whether it be high price to sales, et cetera. They're just moving from one to another. Now they're moving to venture capital and private equity. And before it's all done, they will have crushed a lot of that stuff and paid back the punishment for the sins of the prior episode.
Bill, what do you make of the conflicting commentary that we've gotten from Fed officials today? We had St. Louis Fed President James Bullard. He was saying that more rate hikes are needed. Economic risks remain elevated. Kashkari, on the other hand, saying that there's still a chance of a soft landing. What do you think?
Well, we're a bit conflicted ourselves. We see the fantastic demographics. There's 41% more millennials than there are Gen Xers. Therefore, that's 41% more 26 to 43-year-old consumers of everything from houses and cars to getting married to having kids to do all those things that create necessity spending. And necessity spending is the most favorable spending to what we used to call the multiplier effect in macroeconomics. So that you've got that favorable backdrop. Then the second thing you've got the chronological snobbery in operation here. So I'm 42 years in the investment business, and for 32 years, 7% would have been a great mortgage rate.
But because the rate was almost nothing a year ago, people act like this is the worst thing that's ever happened. So back when baby boomers were a huge group, my first mortgage was 13.5% in 1983. And by the way, in 1984, we built a ton of houses at double-digit mortgage rates. So I think people are missing the boat. We're going to have more permanently higher inflation, probably in the 5% variety. I think the mortgage rate at 6.5 or 7 is doing a pretty good job of discounting that inflation, and therefore whatever softness the landing might have might be because of better necessity spending than people had assumed.
Still trying to digest chronological snobbery, Bill. That's a new one that I have not heard before. But back to those mortgage rates, if you are in a home, you're looking to upgrade, and your mortgage is, say, high 2s, low 3s, that's a double your mortgage payment if you're looking to go buy a new home right now. What do you think lies ahead for the housing market?
Boy, I hate to burst your bubble, but that is a lousy question. What you're asking is are older millennials who got completely spoiled by what's happened to them on their first or second home purchase are going to damage the economy because they don't get to stay as entitled as they were before. That's not who we're concerned with. We're concerned with the millennials that are getting married this year in record numbers and next year who are going to want to buy their first house. That's who we're going to build the houses for, is to meet the demand for the necessity, not the fantasies of the millennials who have spent their 20s going on exotic vacations.
There are no homes for those first-time home buyers right now. They're not building them. You're aware of what's going on in the real estate market. Developers, builders, they flat out don't buy those homes. And are you meaning to suggest that if your mortgage payment is going to double, that you want to support the economy and just swallow that because you're spoiled?
No, you're missing the point.
Please explain.
The point is, I drove from Phoenix to Portland, Oregon, and back 2 different ways. And most of what I passed was empty land. 75% of the United States is uninhabited, and many of those uninhabited places are wonderful places to live, like a Klamath Falls, Oregon, or a Bishop, California. And what you can't do is you can't live in an elitist coastal city and find affordability. But you also don't have to live in an expensive coastal city. You can live wherever you want because all you need is water and Wi-Fi. So Lennar and D.R. Horton are they're going to build homes where people can afford to live, and businesses will locate themselves in a place that's affordable to live. So, for example, let me take you back when Amazon was trying to find a second headquarters. The obvious place was Detroit, Michigan. Fantastic airport, 2 huge state universities to pump grads into your business, and affordable homes in Bloomfield Hills and the rest of the suburbs of Detroit. Now, did they consider that to be a good idea for 1 second? No, they picked New York is where I'd rather be, right? That is what they chose because it had nothing to do with affordability. It had everything to do with arrogance, not affordability. And that's what you're wrestling with. Where are people going to locate their businesses and where are people going to live? And right now, that's not downtown Seattle.
I would love to continue this chat for the next couple of hours. Unfortunately, Bill, we got to roll on to the next segment. Bill Smead, we really appreciate your time. Come back. Let's continue this real estate discussion. Ahead, we're just getting started here on Yahoo Finance Live. We got a very surprising piece of housing data this morning. We'll break down the numbers for you. And new car prices remain high, but there is one area where you might see some price softening later this year. We'll tell you what that is. And if you're planning to fly during the holidays, our expert will tell you the best time to buy those tickets and the best day to travel. Stick around.
松山英樹、彼のアイアンを作る。それが私の仕事だ。世界で活躍する彼の姿を見るとき、俺の作ったクラブが君を支えているんだぞ。そう思えるこの嬉しさは何事にも代え難い
この世界には
Welcome back to Yahoo Finance. Now, lumber prices are rebounding today from a 2022 low. Ines Ferre has more on the price action of the essential building material. So for more, we'll turn to Yahoo Finance's Ines Ferre. Ines, what are you seeing now?
Yeah, Rochelle, we are seeing a bit of a rebound, but keep in mind that just yesterday, lumber futures hit a 2022 low. So let's take a look at the charts on our Wi-Fi Interactive. You can see that lumber futures right now just above $431 per 1,000 board feet. One board foot, by the way, is a 12-inch by 12-inch wide piece of wood. So basically, you are looking at these lumber prices that have basically plummeted year to date. You're looking at the price action down 61%. And a lot of this, of course, has to do with the rising mortgage rates. So as we are seeing a slowing housing market and mortgage rates are inching closer and closer towards 7%, you've got home builders that are shying away from buying materials. You had KB Home, you had Lennar in their recent quarterly report, basically saying that they canceled some lot purchases. I also spoke to a commodity broker who told me, look, because supply chain issues are better now, there is no sense in a slowing market for these home builders to be piling up wood. So you are looking right now at these levels that are pre-pandemic. I'm going to pull up now a 3-year chart. Let's see. I'm going to pull up a 5-year chart here. So you can see that you are looking at pre-pandemic levels for lumber. Lumber losing all of its pandemic gains, guys.
Indeed. All right. Thank you there, Ines Ferre. Dave?
Thank you, Michelle. More now on the housing market. Mortgage rates, as we mentioned there, continue to climb, headed towards 7% on the 30-year, more than doubling from a year ago. Inventory remains low. Prices are cooling across the country. Contracts are being canceled and projects stalling. And then, surprise, new home sales today shooting right back up, jumping 28% in August. That's according to the Department of Housing and Urban Development. 685,000 new homes were sold just last month. Shana, the dynamic overall has not changed in a number of months. We will continue to see exceptions, bounces here or there, but overall, the Fed is determined to win this fight, and we saw housing begin to struggle before any other portion of this economy, and we're going to see that falling off in prices across the country with notable exceptions. Miami coming up later in the show. They will win this fight, and the problem is these mortgage rates are keeping sellers and buyers on the sideline, because as we argued with Bill Smead, you're not going to upgrade to a bigger home if you're going to pay double your mortgage rate right now. You're just not going to do it, and you're also not going to sell right now because of that.
Exactly, and also if you're a first-time home buyer, you now have a less likelihood of being able to afford a home with a mortgage right now, nearly double what it was during the pandemic. So comparatively speaking, obviously, the housing market here showing signs that it is slowing. The new home sales number stuck out to me. Yes, you can take a look at that number, 29% jump. Yeah, we have seen some commentary, a number of economists weighing in on this. Greg Dacko of EY Parthenon, he was on the show yesterday. He tweeted out this morning that this number was likely a head fake, because you also have to keep in mind those inventory levels. Simply, home builders are not building the number of homes that are needed right now in order to really help with supply. You also have the fact that sellers aren't selling because of that higher mortgage rate that you were just talking about. Zillow was out with a report saying that new listings dropping nearly 23% in August from a year ago. So Rochelle, it's hard. I mean, I don't think there's any argument to the fact that, yes, the housing market is slowing, but obviously the degree of this slowing and what we could potentially see over the coming months is what people are debating right now.
I mean, and it's tough though, because as we see, mortgage rates, when you compare them to where they were, say, in the 90s, obviously compared to back then, things would look pretty good. But you have to remember, we were in a place where we had historically low mortgage rates for a very long time. And even over the course of the pandemic, when you look at the size of the millennial population, households have grown, the size of them have grown. So they do still have a need to get into a place. Rents are still too unaffordable. So there is that need. They do have a need for these things. So it's interesting to see then, though, a lot of these lumber, these home builders saying, look, it's not worth for us to do it right now if some of these people just want to stay on the sidelines. But at a certain point, as we're seeing, though, once we saw some of this, the frothiness, we saw people sort of waiving everything, waiving every contingency with houses. Now that we're not seeing that as much, perhaps we might start to see people trying to come back into the housing market for the first time.
Yeah, the people that you are hearing from right now are those that bought at that massive peak in the pandemic. Those are people who are worried, who are inevitably going to lose 20 to 30% of their value because they bought at ridiculous rates. Now, those that want to say this is like 2008, 2009, 2012, nothing like it. We're not built on a house of cards like we were back then with those types of loans being thrown out. And the bottom line is the inventory, though it's coming up, is still historically low. So these prices don't have very far to fall.
Yeah, and it's also interesting just looking at some of this data in terms of home buyers backing out too. Like, that's another dynamic that's playing out right now, especially in some of these Sunbelt cities. And these were the cities that attracted so many people, so many new homeowners during the pandemic boom. The fallout that we've seen there, Jacksonville, Florida, 26% of buyers backed out of contracts in August. Las Vegas, 23%. Atlanta, nearly 23%. Orlando, Florida, which you are just back from, nearly 22% of buyers backing out of these contracts. So as we start to see potentially that picking up as well, obviously this could really spell much more trouble here for the housing sector at large.
And you certainly did a bit of more than you can chew when you signed up for this before the rate right-rising period kicked in. So a tough spot for homeowners and those prospective buyers right now. All right, well, coming up, Domino's shares taking a hit after an analyst lowered the company's price target. We'll give you the reasons why next.
オッズパークは馬がダメでもチャリがある。チャリがダメでもオートがある。パーパーパーパーパークオッズパーク
オッズパーク今すぐダウンロード。
It's time for Triple Play, the three stocks that we're watching in the final 30 minutes of trading. We have Keurig Dr. Pepper, Domino's, and General Motors. So we're starting off with my pick, which is Keurig Dr. Pepper, ticker symbol KDP. Now, shares of the beverage maker under pressure this afternoon, down about 3% there, falling this afternoon after a downgrade from Goldman Sachs to neutral from buy. Now, as the reason for caution, Bonnie Herzog and her team at Goldman really cited an increased risk to margins as commodity inflation, especially coffee-related, remains elevated for KDP versus its peers based on Goldman's updated commodity tracker. So they also lowered full year 2022 and 2023 estimates slightly, putting them below consensus. Now, on top of that, though, you have other headwinds for KDP that include brewer household penetration starting to normalize. You have pod attach rates moderating, and then, of course, a slowdown in their packaged beverage business growth market and market share gains also slowing as well. But not all bad news. Goldman also said that KDP is still executing well despite the challenging environment and also has strong underlying momentum in its coffee and packaged beverage businesses. And they also highlighted ongoing initiatives to expand and enhance distribution capabilities. So clearly not a bad day for KDP at this point, but obviously that caution, though, really weighing on the stock there. As we said, they're down about 3% today, Sean.
Yeah, higher commodity prices, obviously an issue here for Keurig Dr. Pepper, also an issue for many of their peers out there. It's interesting, though, that this call is coming out now because the company has actually been able to weather the uptick that we've seen in coffee prices relatively well. Taking a look at that one-year chart, the stock is still in the green. Yes, it's getting hit today because of this call from Goldman Sachs, but over the past year, stock up still about 6%. So we'll see how high potentially the coffee prices might climb and when, of course, that will be an issue here for Keurig Dr. Pepper. All right, my play today, Domino's. Cowen lowering its price target on the stock because of two headwinds, they say. Delivery driver staffing levels and also a slower pace of store openings potentially. Now, analyst Andrew Charles writing in a note that staffing levels for delivery drivers has plateaued in the current quarter, and that, quote, does not lend confidence to an acceleration here in three-year trends. He also pointed to a risk that 2023 openings trailing the 6 to 8% long-term guidance that we got out here from Domino's ahead of time. Cowen updating its price target to just about $362, comparing that to where we are today at $314 a share, still about an 11% upside. So yes, Cowen reining in some of their expectations, Dave, when it comes to what they expect to see over the next 12 months, although still much higher from where we're trading today.
Contreras is BMO analyst Andrew Strelzik. He's got a buy and a $430 price target. That's a 35% upside, citing their own survey that says 80% of their own respondents indicated a desire to increase spending over pizza in the next 6 months. This is recession food. Domino's Pizza, you know, is my personal favorite, and if we do hit a recession,
I don't understand that, but that's a whole other
$3-item pizzas is a steal.
You can't beat the price, the taste you can beat elsewhere. I know, we can debate about it. We live in one of the best cities for pizza, and you ordered Domino's.
It's
but
tremendous.
All right,
it's
we'll
delightful. I'm going to get you some Domino's. You are going to love it. My play is General Motors throwing return to office plans in straight reverse. On Friday, GM announced plans to bring corporate workers back to physical locations at least 3 days per week later this year. After significant backlash from employees, though, today they walked back that plan, saying they won't be mandating specific in-office days, and they'll leave that up to the individual teams. GM said it will announce further updates by the end of next month after spending the next few weeks, quote, continuing to listen to feedback. Now, Ford, on the other hand, has also updated its return policy, recently emphasizing their increased flexibility is what they think is a real advantage in hiring top talent. Shares of GM down more than 40% year to date, and down today just about 1%. We're down much bigger earlier on. Overall, part of a much bigger discussion on return to office plans. And clearly right now, Rochelle, it looks like a tight labor market is going to win out, because all these companies get out there, they announce these plans, and then they slowly walk them back over backlash. And that looks to be the deal until a recession, if a recession hits, and then we might see everyone return to office.
I mean, it's true, because we've seen the stick method where they try and force you to come back. We've tried the carrot method where they'll include all kinds of perks. They're like, oh, you want to play pickleball? You want to do this? But at the end of the day, though, from the surveys that I've seen from different work from home surveys, the main reason that people aren't coming back is because they have a lack of compelling reason to want to come back physically. If they're seeing that they're just as productive outside of the office, they're trying to find a reason to have to come back. And WFH research actually found that just 49% of employers who told them they had to return to the office full-time 5 days a week actually ended up turning up. So you can't really reprimand or fire people in the labor market this tight once you've really invested in them. So I don't think this is changing anytime soon until, as you mentioned, recession hits and the job losses become more severe and people really have to think twice about it. But at least for now, it does seem to be in the employees' favor, Sean.
I don't know. It could happen much sooner than we think. If we do start hitting some of those unemployment projections that the Fed has said, we certainly will see. They think we will see a slowdown in the labor market, in the jobs market. So, of course, that would give management at some of these companies an upper hand, because employees won't have too many options, at least to go elsewhere for the time being. I still think this whole return to office saga, how it's playing out, is interesting to me, because it makes sense to be back in the office. I get the whole hybrid schedule. I get that maybe you only want to be back 2 or 3 days a week. That makes a lot of sense. But being back in the office is much more productive, I think, team-wise, than everyone working from home, just in terms of the culture, building relationships, being able to have those one-off conversations, especially with your manager. That doesn't happen as often when you are working from home, at least when we were working from home from some time before we came back to the studio. So I think there is a reason. I do think these managers have a point here in trying to get their workers back to the office.
Yeah, and also don't factor the sideline deals. And I'm not just talking about big deals that are made like at conferences, but what happens on the sideline, whether it's after work at getting a beer, makes a huge amount of difference. Unfortunately, we can't have a debate here. We all kind of agree. Rochelle, get back in office, all right?
I know. Rochelle, you got to move up here to New York.
Half the people say, no thanks. So what can you do?
All right, well, moving on here, the Department of Transportation announcing it has approved all 50 states' plans for the first nationwide network of EV charging stations. We'll find out how big of a first step this could be next.
K-POP のダンス動画を見てブラックピンクの大ファンになったら、ミュージックビデオを思いっきり楽しんだり、ドキュメンタリーを視聴でき楽しみが途切れない。 YouTube プレミアムなら広告なしの動画のオフライン再生が可能。まずは1ヶ月無料体験。
Like many consumer goods, the cost of cars remains high. But our next guest, though, says that there may be some relief on the horizon. We want to bring in Edmunds Executive Director of Insights, Jessica Caldwell. Jessica, it's great to see you here. So the cost of new cars obviously remaining high. We have started to see some relief when it comes to used cars. I guess, do you expect that relief to stick? And when should we expect to see the cost of new cars follow suit?
Well, it's not, I would say, absolutely fantastic news, but what we have seen this year recently is a return to seasonality in the used car market, because every year we see January used values are a little bit higher, and as the year goes on, they decrease. They get older, they have more miles, a little bit more wear and tear, so it makes sense that a used vehicle in September is cheaper. However, that's not what we've seen in the past few years because the car market has been so topsy-turvy. So I feel like that is the first good sign that things are sort of going back to normal. Things are, used cars are still expensive if you compare them year over year, but at least we're not seeing that atypical non-seasonality phenomenon that we've had for the past few years.
And Jessica, it feels like we used to get bombarded with all these blockbuster sales for used cars and new cars. It doesn't feel like we get that as much. Is that going to come back at any point?
It probably will come back, but I would say those blockbuster events, I mean, right now we are in September. Usually this would be end of summer sales events, model year sales down. Those are probably things that you remember. That doesn't have to happen because there's just no inventory to sell down at this point in time. I do think that inventory will get better. Will it be as much as it once was, where there's just tons of options on every dealer and every dealer is trying to undercut another dealer? I don't know if we're going to get to that. that seemed to be maybe an unhealthy place, but I think it'll be somewhat in the middle. I mean, right now the inventory is far too few, but to go back to those days where it's just the discounts were so heavy, I don't know if we'll exactly get back there.
The new car dealers I talk to love this dynamic. Low inventory, high prices, lower employees. What's going to change this dynamic, and how essential is it for the Fed's fight against inflation?
Yes, so I think for car dealers, this has been a good time. They've got high margins. They're not having to sell as many vehicles. They're not having to just work on volumes, which is a really stressful business of trying to make your number at the end of the month and all of that goes with it. But I think moving forward, there's just not enough vehicles for consumers, and that is an issue because consumers are walking to a different brand. They're trying to figure out if another car is going to work for them because either they don't want to pay the higher prices or they don't want to wait, because that's the new thing too. Americans, we don't want to wait for our goods. We want them today, right now, and that is not happening either. So I think that this is probably not the system that is exactly ideal. So we probably are just going to have to keep, I would say, adding to the inventory, get it back to a normal level where it's not as if you're going to lose customers, because that really is the danger for auto companies as well as dealers, is they're just going to walk because someone else can offer them a car in 3 weeks and maybe at MSRP versus waiting 2 months and a few $1,000s over MSRP.
Jessica, how much of this is because of when we talk about the increase in cost here, how much of it is because of the supply chain aspect of it, the fact that suppliers are raising their costs and therefore some of these automakers are being forced to pass that along to the consumer?
Yeah, I mean, there's probably a few dynamics going in. One is consumer driven. Over the years, people, especially in this country, we wanted larger vehicles, we want more options. As a result, a lot of companies, especially Detroit companies, they shuttered their smaller car lines. So that has naturally driven the price of vehicles up. And then we hit this supply shortage, mostly led by the semiconductors, which has made inventory really scarce. And I think that is what really has propelled these prices that we see above MSRP or at MSRP, and it's a little more atypical than what we've seen in the past. This industry has never seen an issue where not having enough inventory is the problem. It's usually just sluggish consumer demand, and that of course is not the case. But a part of these rising prices has been our own tastes. We like nice things. I think that's fairly typical of what we see when we look at cars around.
And so what are some of the trends that you're seeing in the leasing versus buying decision making?
Right now, the leasing market has really taken a hit. People are not necessarily as interested in leasing. A lot of leasing relies to get those low monthly payments that you've seen, the $499, $399 a month. It relies on automaker incentives, either subsidizing the interest rate or the residual value. Automakers haven't had to do that right now because inventory is so tight and people will just buy them outright. So as a result, the leasing deals aren't really good for consumers out there. So they're not leasing. Even brands that are normally leased at such high rates, like the luxuries like Audi or BMW, even those guys are not leasing very many vehicles because it just comes down to what just makes more sense. If you're going to pay such a high price, I'm just going to buy the vehicle.
Electric vehicles, stunning national average transaction of 61,955. Given gas prices are continually falling down and recessionary fears, what's likely to drive that supply back up, and what is the pricing action? Where are we headed with EVs?
Yeah, I mean, the biggest issue with EVs is that automakers can't make enough of them. I mean, there's virtually waiting lists for nearly every EV on the market. I mean, some EVs like the Ford F-150 Lightning are so popular, I don't even think you can get on a wait list right now. You have to wait till the next model year comes out. So the issue, I think, is really supply. Of course, having a transaction price over $60,000 is not going to be the end goal for a lot of automakers. That is out of reach for a lot of American consumers. So the goal is to bring down the price in terms of product, really. So introducing less expensive vehicles like we saw a few weeks ago at the Detroit Auto Show with the Chevy Equinox EV. That will be here. That's promised at $30,000. So I think for this market really to grow, the vehicles have to come down in cost, but it is a bit of a catch because the supply is so short, and it's going to be short because of some of the commodity issues that automakers are facing to build these vehicles.
Jessica, we did get news today. The Department of Transportation here approving the electric vehicle charging station plans for all 50 states. We know President Biden and his administration has been very ambitious in some of their EV goals. I guess, to what extent does this really move the needle?
It definitely does, because I think with EVs, it's sort of a chicken and egg. It's like, do people buy them first without charging, or chargers built first and then people will buy them? So there always has been a lot of confusion. But what we know is that these two markets have to move in parallel. People are going to buy EVs at high rates. California, for instance, saying that they're banning ICE sales by 2035. These charging stations are going to happen. And Americans do buy cars on the notion that they are going to drive one day across the country, even if we never do. So having that national infrastructure of charging is extremely important for people to make EVs their sole vehicle, because right now we see EVs as a second or third vehicle, but to make it that person's only vehicle, this is going to happen. So I think a lot of things have to happen in this market for people to feel comfortable, but infrastructure is obviously a very crucial one.
Certainly is. All right, Jessica Caldwell of Edmunds, thanks so much for joining us. Well, in the meantime, take a look at shares of Ford. You can see just under pressure today. Now the automaker announcing it will invest $700 million in a Kentucky truck plant and add 500 jobs. This is in an effort to support production of its 2023 model year F-Series Super Duty truck. Now, this is the first wholesale redesign of this truck since 2017. It also shows that even as Ford is investing and betting big on EVs, the automaker is still staying true to its roots with its trucks. I will be sitting down with Ford CEO Jim Farley, and you, of course, will be able to watch the interview tomorrow right here on Yahoo Finance.
Looking forward to that, my friend. Ahead, new data shows home prices in Miami are still on fire despite rising interest rates. One of Miami's top brokers joining us next to explain why. Housing prices cooling across the country as the Fed chair seeks a, quote, difficult correction to bring supply and demand back into balance. But there are exceptions to that rule, notably South Florida. That's where you'll find Dora Puig, principal broker and founder of Luke's Living Realty. Dora has over $4 billion in career sales. Nice to see you. So this morning we get new data from the Case-Shiller Index showing Miami prices up 32% year over year. What are you seeing in the Miami market?
I'm seeing a little bit of a slowdown over the summer, but this is typical of our market because of the seasonality. It was low season for the first time in 3 years since the pandemic. So everyone went to travel. Travel bans were lifted, no masks. So we were back to our low season, but we've definitely seen an uptick in traffic in the last 2 weeks as we're getting ready to start our high season again.
Redfin showed us some numbers earlier that luxury market across the country down 28%. That's the largest they've ever seen on record and far outpacing the lower level. You deal with primarily the luxury market in Miami. Are you seeing a dramatic impact of mortgage rates double where they were from a year ago?
I'm seeing a bit of an impact in the $5 million market and under. That's typically the buyer that needs a mortgage. We're starting to see prices drop a little bit and inventory creep up a little bit in that market because I believe that market is the market that's getting most affected in Miami-Dade County where I work, in the $1 million+ market. In the high end, when I start to think of $6 million+ market, it's typically cash deals and I don't believe they're going to be as affected. Our trophy residential market, I think, will absolutely not be touched. And that would be north of $20 million.
The Citadel CEO, Ken Griffin, recently moved his company to Miami from Chicago. Who are the buyers? Are you seeing potential people move from New York, from Chicago? Are they moving from within? Are they international? If you could paint a picture of the typical luxury buyer there in Miami.
The luxury buyer, I always say, has been good old USA, red, white, and blue since 2015. This has been New York, Chicago, California, all the winter climates, lots of Toronto and Canada I've seen. The international market's been very light because the dollar's been so strong overseas. We're still seeing a huge influx of New York, New Jersey, and the Northeast corridor, consistently purchasing in our luxury residential market. I think Ken Griffin's Citadel move, which is slowly starting to flicker in, is going to be a huge buffer for our luxury market. So if all these interest rate hikes and the conversation about a more narrow landing to recession does hit Miami-Dade County, I think 1,000 families moving to South Florida from Citadel is going to be a huge buffer for our luxury market.
He himself threw down $100 million on, I think, the biggest purchase there. The people who might come from Citadel and some of the people you mentioned earlier really invest in the market. Are you seeing a pullback in buyers because of where the stock market has gone in recent weeks? And are you also seeing fewer real estate investors that really drove those prices up?
We've predominantly been in an end user market. It hasn't been a huge investment market in the residential business. Maybe commercial's seen a lot of investors, commercial real estate. Residential here is really end users, turnkey, move in. They're worried about schools. They're worried about location and area. That they're going to live here. So I don't believe it's so much investment as we used to see in the old days with the Latin Americans. Ken Griffin's going to be moving also possibly to Star Island, where he bought a 4.5-5 lot parcel to build a home. So all of these Citadel people that are starting to flicker in are pretty much the top end of the market. I haven't seen yet the lower end start to create sales because of his move. There are also a huge amount of other investment banks coming, Goldman Sachs, the Apollo Group. All of them are opening offices between Palm Beach and Miami-Dade County.
All attracted to those tax rates. The inventory has been the real backstop nationwide that prevents a big crash in prices. What's the inventory story in Miami?
Well, we're still very, very low on luxury residential inventory, which is what I think is going to give us a huge buffer this winter. When we start our high season, November 1st, November 15th, I expect all of the luxury inventory that's kind of coming out in the market right now to get absorbed. So I'm still bullish on Miami. I don't believe it's going to be a total frenzy as it was the last 20 months, but I do believe we're going to have a very solid winter selling season.
Yeah, that type of frenzy is certainly unsustainable even for Miami. Dora Puig, great to have you on Yahoo Finance. Thanks so much. Appreciate it.
Thank you. Great to see you, Dave.
All right, coming up, Intel introducing its newest line of chips. Find out what it means for the ongoing battle with AMD when we come back.
It has been a brutal time for semiconductors. Those chip stocks have taken a huge hit as rates rise. We know that, of course, is a huge headwind here for some of the biggest names within the sector. Nvidia, of course, bouncing off its 52-week low, off just around 23% in the past month. AMD has also been under a tremendous amount of pressure, dropping more than 26% in the past month. Competitor Intel not too far behind, off nearly 20%. But Intel is trying to turn things around. The company debuting its new 13th Gen Core processors today. Yahoo Finance's Dan Halley joins us with those details. Dan, what can you tell us?
That's right, Shauna. They introduced their new 13th generation Intel Core processors today. These chips, they say, top out with its i9 processor. They say it's the most powerful computer processor in the world, at least as far as the standard home processors go. And sure, there's bigger ones out there in supercomputers, but this is supposed to be one of the ways that the company is trying to wrestle back control of the market from the likes of AMD, as well as competitors like Qualcomm, which are increasingly pushing their way into the PC market. The event here, Intel Innovation, focused though primarily on what developers can bring to Intel and how they can help expand the company's value. They used to have an Intel Developer Forum conference. This now is taking place of that. And this is something that Pat Gelsinger pushed on stage during his keynote, basically talking about how developers will help push Intel into the future, not just its silicon. One of the big showcases they had was, believe it or not, some of the vision technologies that they have using the likes of Chipotle as an example, how AI vision computing can be used to help restaurants see what kind of products they have that are running low and then quickly put them back into place. There was a really interesting demonstration that Pat Gelsinger was showing grabbing salsa verde out of this case that was supposed to be a simulation of what a Chipotle bar would look like, and then really quickly having the AI being able to say, look, you're running low on this particular product, you have to refill it. So they're really pushing forward with this developer aspect of things and hoping that that gets them back to where they were. Obviously, Intel had a very, very rough Q2. Q3 also could be problematic, and we're looking at that, as we said, because the PC market itself really starting to fall flat, although we've seen servers kind of holding up on their side of things.
Indeed. Intel pushing ahead, though, by the sounds of things. Great to have you on. Dan Howley, thank you for joining us this afternoon. Right, well, coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
All right, we are just minutes away from the closing bell. Now let's bring in Yahoo Finance's Jared Billick to break down all the market action and see if we can rally towards the close. Jared?
Yeah, looks like we got the NASDAQ barely in the green, but that doesn't count for much, does it, when we are breaking news? Still in a bear market. I guess that is actually not breaking news. Here are the NASDAQ futures so we can see the AM action as well overnight, but we have descended into bear market territory a few times today, probably closing around that level. Want to get to the heat map action. Here's the sector action for today. We got a mixed board, energy in the forefront. There's some speculation that OPEC Plus at its next meeting may announce some production cuts. We'll have to see what comes of that. But mostly things are in the red here, although we do see the defensive sectors more in the red. So it could be a ray of sunshine there. Here are our leaders. We have TAN, that is a solar ETF, followed by ARK, cannabis, meme stock IPOs, all of those outperforming. Throw transports and biotech in there too. Not a bad look today. I do like to check in on travel as we approach that closing bell. Carnival, Royal Caribbean, and Airbnb, all of those in the green for more than 3% today.
right, stocks ending the day mixed. You can see the NASDAQ holding on to gains. I guess a sliver of hope in this market sell-off that we have been dealing with for the past several trading days. NASDAQ closing up just around 0.25%. S&P and NASDAQ, though, in the red once again. S&P off just around 0.2%. Dow closing off its lows of the day is still off 123 points. All right. For more on today's broader market action, let's bring in our guest. We have Michael Kushma. He's a Morgan Stanley Investment Management Chief Investment Officer of Broad Markets for the Fixed Income team. And we have Jas Thandi, AM Partner of Portfolio Strategy. Michael, let me start with you just in terms of the action that we've been seeing play out in the bond market, because that, of course, has been driving the moves that we've been seeing in equities. We have the 10-year yield continuing that march higher, not too far from 4%. The spike that we've seen in the 2-year. What's your takeaway from that action?
I think what we're seeing is the market throwing in the towel that the Fed is serious about raising interest rates as far as necessary in order to beat down inflation. And this month's FOMC meeting, while on the face of it seemed like they did exactly what everyone thought they'd do, raising rates 75 basis points. But what they did do was raise their expectation that the terminal rate, the final highest yielding Fed funds would be 4 3/4, almost 100 basis points from where previously they had estimated. And the market is embracing that in the sense that it's a reasonable expectation given the Fed's commitment to reducing inflation.
And Jas, we've heard from Fed Chair Powell, look, he's saying, I'm going to be looking at 3-month, 6-month, 12-month views when I'm looking at this thing. But the markets, though, seem to react to every single data point that comes out. How should they be digesting the messaging from the Fed versus what they're hearing from these data points that come out?
I think it's the data. I think the Fed's made it clear they're going to be data dependent and drive their views through data. So I think the data will drive volatility going forward. What we've seen is any bit of news, yields react, and therefore stock markets react. When we look forwards, this next week is going to be a big week. We've got GDP coming up, some confidence numbers, next week income numbers, and all of that is going to drive future volatility, because that is what is ultimately going to dictate the Fed's path. As Michael mentioned, markets more realistic now in their pricing, but I think it's markets really don't know how fast, and how the Fed does it, because we haven't been in this environment before. So we expect volatility to continue.
Michael, if the markets are throwing in the towel, how long do they stay on the mat, and what gets them up off of it?
Well, I think we have to see some change in economic performance. Up till now, the labor markets have been rock solid, and the Fed believes, as most market analysts believe, that wages drive inflation in the medium term, with U.S. labor markets staying very tight, wages rising 6 to 8%, depending upon what you look at. There's very little to be optimistic about that inflation will drop back to the 2% level anytime soon. So the key factor is what will drive consumers' spending down, what will drive consumption down, what will make the labor market loosen up a bit. Then market will say, maybe rates have finally reached their peak.
Jas, when you're trying to look for any good news here in this market, can you find something for us?
I think it's really going to. I think we could end up in a world where bad news becomes good news, right? What we've had now is good news is bad news, because the Fed has to continue to tighten. But I think it's really going to come down to seeing some of that economic numbers roll over. I think it is slightly comforting. We have seen some of the growthier sectors perform okay today, but I see that battle continuing. I don't see much out there. I think there could actually be more bad news based on what's going on with earnings right now, and how that's looking at the expectations for next year, which are close to 9% earnings growth year on year for next year, which seems, but it could be an at-risk number for next year.
And Michael, what do you think is the best way to position your portfolio when you do have this environment, and when you have the Fed looking at inflation, and then also perhaps with that lag now, of course, with the real economy data behind it?
That's a very, very good point. That the stuff that we're looking at, the labor market, consumption spending, consumer confidence, some of this stuff is lagging. It's looking backwards. And the danger, of course, is that the Fed keeps its eyes on the backward-looking data, the lagging data, and raises rates too far. So the danger is the Fed keeps going when they shouldn't keep going, because the labor market responds with a lag. Next year's wage settlements, wage growth is probably dependent on what happened this year, not so much what people think is going to happen the next 12 months. So I think in terms of what we're positioning is valuations are getting better in the bond market. We haven't seen yields like this in a long, long time. As we saw, the 10-year Treasury is closing in on 4%. cash rates are 4%. I think it's a bit premature to get too optimistic that we've seen the peak in yields, whether it's an investment grade credit or US Treasuries or other high quality bonds. But we're getting to the point where on a longer term horizon, looking out toward the end of next year, yields are getting to levels which look like okay. In other words, they're high enough to weather future volatility. But in the very short term, meaning now for the next couple of months, we think staying conservative, shorter maturity assets, short rates may have peaked. Even if they haven't peaked, they're not likely to rise by only a fraction what they've risen recently. So it's all looking a little bit better in terms of getting enough income, which is what fixed income's about, in order to protect you from any uncertainties and volatility in the future.
And Jas, we'll tag you in on a strategy with all these headwinds. You recommend investors build resilience in their portfolio. How so?
Yeah, so for us, with our clients, it's really looking at things that are backed by things like real assets, like real estate, some kind of infrastructure funds based on the Inflation Reduction Act spending that's going on. And this is all about really insulating yourselves from the possibility of the equity bond correlations becoming more positive now on a more permanent basis. So for us, it's really about adding those assets that have less correlation to those two main bellwethers of portfolios to create that diversification for our portfolios.
All right, Jas Tandy and Michael Kushma, appreciate you both being here, weighing in on this tough environment. Have a good one. Ahead, airline workers across the country picketing for better pay and safer work conditions. A leader in the union representing flight attendants joining us with their argument next. Southwest flight attendants are picketing across the country today as their union negotiates a new contract with the airline. For more on this story, we're joined by the president of that union, Lynn Montgomery, of the Transport Workers Union Local 556, which represents the airline's more than 18,000 flight attendants. Nice to see you. And a statement you say never before in the history of Southwest have working conditions deteriorated so rapidly. What changed for flight attendants in the last couple of years?
Well, the last couple of years have been extraordinarily difficult for flight attendants at Southwest Airlines. And actually, some of these issues existed even before the last couple of years, which I'll call the pandemic years. But we have had to work long, exhausting hours. We're having to sit on call 24 hours, which is causing some of our flight attendants to stay up 24 hours. We have been just the victims, along with our passengers, of horrific technological failures that have created chaos throughout our personal lives and our daily work schedules. And we're just really needing to see some changes.
Lynn, what are some of those horrific technological failures that you just mentioned?
Yeah, so the company has experienced technological breakdowns large enough to impact nationwide flights nationwide, where flight attendants have had to wait for hours on end just to find out what their next assignment was, or when they would be going to a hotel, or where their hotel was. I mean, we have reports of flight attendants having to wait 3 to 4 hours on hold with crew scheduling for their assignments and hotel reservations.
And I understand there's been a number of delays during this negotiation process. How has that affected your ability to really negotiate?
Well, unfortunately, the negotiations have not been going productively or fruitfully. So we have filed for mediation, and we'll be meeting with a mediator in November with the company and a federal mediator, because we haven't found that the talks have been progressing at all.
Specifically, what is the number one thing you and your fellow flight attendants need from Southwest at this moment?
Well, we really need Southwest Airlines to understand that that we can't be saying sorry anymore with all these technological breakdowns. We need quality of life changes, and we need to be paid for all of our hours worked.
In terms of the pay incentive there, obviously a very critical part, very important part of this contract that you're trying to negotiate with the Southwest. I guess more specifically, are you looking for an increase in terms of salaries for what you're already working, or just those additional hours?
You know, increase in pay is always something that's on the table, but we are actually looking for a lot of quality of life issues. You know, when Southwest Airlines has these operational breakdowns, or you are delayed because of weather, it's really having an impact on flight attendants' lives. And we're not seeing pay for that overtime that we have to put in if we have to stay a few hours, or many hours after our shift, or even working extra days. We're not actually seeing that pay as good as we should be seeing it.
And what about some of the benefits that you're also looking at in terms of things like better health benefits?
Well, one of the most tragic things I think that can happen to a Southwest Airlines flight attendant is when she or he gets injured in the line of duty. You can actually lose your flight benefits while you're out on the job injury leave. And that's just really despicable when you have been working in the line of duty and you get injured. We also want to be able to see that flight attendants can retire. And we also want to see that if you are having a need to stay home with your children, or need to breastfeed, that you're given the time to be able to do so without losing your health benefits.
And just to be clear, you are not striking. Are you willing to strike? And one of the most recent changes in the last several months has been alcohol has returned to airplane flights. How has that changed working conditions for flight attendants?
Well, initially when the alcohol returned, we were still under the mask mandate, and that was really the difficulty there, because flight attendants were having to govern the wearing of the masks, and that really generated a hostility on board the aircraft, and flight attendants ended up having to be the victims of many assaults and aggressions from people who were upset that they were required to wear a mask.
Lynn, what has the response from Southwest been? Have they been open to some of the changes that you and other flight attendants that you're representing want to make?
Southwest Airlines really doesn't want us to ask for as much change as we need to see. They've been asking us to narrow our scope. Unfortunately, the flight attendants' contract really hasn't changed significantly since 2009, but our operation has changed dramatically. So we really need to see a contract that steps up and stays in line with the operation that we have today.
So I want to ask you, obviously, about hiring. A lot of people seeing this news, seeing the moves coming from Southwest. What is this doing in terms of the new hire pipeline? How is the union addressing that?
So the company is hiring quite a lot. We actually meet with new hires while they're still in class, and we have a new hire committee where we reach out and talk to them. And I have to tell you, it's a little disheartening because many of the new hire flight attendants that are coming to Southwest Airlines are feeling the impact of the exhaustion after a long day because of the way that our duty days work and the way that we are scheduled, and they are quite surprised by that, and some are considering leaving.
Goodness, well, we certainly hope that's not the case. We thank you for what you are doing. Transportation Workers Union Local 556 President Lynn Montgomery. Well, we reached out to Southwest for comment, and they had this to say. Southwest Airlines has an award-winning culture that respects our employees and encourages them to express their opinions. Southwest looks forward to continuing negotiations with TWU 556 and the National Mediation Board so that we can reward our flight attendants and continue attracting great talent. We certainly hope there is a middle ground that can be reached there. Well, Fed Chair Jerome Powell weighing in on a central bank digital currency. Our next guest tells us why a move towards a digital economy is inevitable when we come back.
Leadership changes coming to two crypto firms today. David Hollerith here with all the details. David, what are we learning?
Dave, Alex Mashinsky, co-founder and CEO of the bankrupt crypto lender Celsius Network, resigned this morning. He said in his statement that he regrets his continued role as CEO has become an increasing distraction and that he's very sorry about the difficult financial circumstances facing Celsius customers. Now, prior to his resignation, in his leadership position, Mashinsky had become a key focus for the bankruptcy proceeding, with dozens of customers turned unsecured creditors, alleging that his public statements around the business's health misled them. Now, added to that, the industry insiders have also issued lawsuits and reports that have shared claims suggesting that Mashinsky also manipulated the price of Celsius's token for his own personal gain. On a slightly better, or I guess we could say lighter note, Brett Harrison, president of FTX US, the US operating subsidiary of crypto exchange FTX, is also stepping down as of today. Harrison announced this over Twitter, and with the change, he is becoming an advisor to FTX US, having cited his desire to work as a financial technologist and yet remain in the sector. In a related change, FTX US will also move its office to Miami, Florida. And as to whether there will be another president for FTX US, the company has not yet made it clear.
A lot of office, a lot of crypto action down there in Miami, isn't there? Meanwhile, Microsoft also led a big funding round for a Web3 data startup. What can you tell us?
Yeah, today Microsoft's venture arm M12 led a $20 million strategic funding round for a decentralized data storage startup called Space-Time. Now, this is sort of an infrastructure firm that specializes in what you would think is the crypto version of cloud data. And its aim is to sort of make that data more accessible to not only companies that aren't working in the crypto space, but also just companies in general working in the space who want to have more efficient access. Now, as part of the round, Space and Time will integrate with Microsoft Azure, which will give Azure customers an on-ramp to blockchain native data, according to the release. Generally speaking, though, venture obviously has slipped for the sector this year compared to last year's bull market. But this year, the trend has been that VC firms have been eyeing early stage startups with a focus on crypto infrastructure companies such as this.
Okay, David Hollerith with the very latest for us on these changes. Rochelle, over to you.
All right, thanks, Dave. Well, central bank digital currencies, or CBDC, in focus once again today, as Federal Reserve Chair Jerome Powell says there's a real need for improved crypto regulation. That happened during a panel hosted by the Banque de France. We're here to break down the current landscape surrounding CBDCs is Jonathan McCollum, Davidoff Hutcher, Citron Chair of Federal Government Relations. Good to have you on the show. So a lot of people wondering, we'll take a step back here, because obviously you have cryptocurrencies, you have stable coins, and then you have CBDC. How do the regulations differ with these?
Yeah, so it's interesting. The White House just issued a digital asset report, a comprehensive framework that came out, where it touches on several of these aspects. The White House called on federal agencies to look into crypto assets, also explore central bank digital currency and the benefits and risks associated with those, and then also asks agencies to provide more clarity and guidance for cryptocurrency companies here in the U.S. As they move forward. As we're looking at central bank digital currencies, there are hundreds, over 100 countries currently exploring, in the exploration phase of launching a CBDC. I think that, there are a lot of reasons for the U.S. to get involved, to maintain its status as a global reserve currency and to promote American values as the CBDCs start to pop up more around the country.
Because as we look at some of the countries leading the way when it comes to CBDCs, obviously China leading the way, how far behind, though, is the U.S. in really getting that off the ground?
I think we're about 4 or 5 years away from, being fully operational. But it's important to start now. And I think that the White House and Department of Treasury and the Federal Reserve are in that process. They're still conducting research and have further some further reports that they're looking at on design, implementation techniques. But I think that the U.S. will be moving forward here shortly.
And we know that Fed Chair Jerome Powell talked about the minimum criteria for a CBDC. The Fed has been tasked with some of this ongoing research that you were just mentioning. I want to have you take a listen to what he said about this criteria.
If we were to pursue a CBDC, it would at a minimum have the following four characteristics. First is intermediated. Second is privacy protected. The third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system.
Now, obviously, he was drawing comparisons to how the current financial system is governed, though. But as you talk about this 4 or 5 years, this is a multi-agency effort here, including the Treasury as well. How much red tape do you think we're going to have to go through at each stage to really actually get this off the ground?
Yeah, and Chairman Powell has said that he doesn't feel comfortable moving forward with the development of a CBDC without some congressional authorization for the Fed to do so. I know the Justice Department here in the U.S. is looking into that, the legalities, but I think it's important for kind of an all-of-government approach in order to move forward. A couple things that he touched on there, it's important for this to be an intermediated model and to run on existing bank payment rails. So this wouldn't be something where an individual consumer would have a credit or an account at the Federal Reserve. It would function through intermediaries, banks, community banks, payment providers, and then filter down to the consumer. He also touched on privacy, and I think that's a really important component to what we're looking at. Our current existing laws that we have on the books here in the U.S. really outline several areas of how cash should function. Should be printed and minted at the Department of Treasury. It then goes to the Federal Reserve, where it's a liability on its books, and then is distributed by the Federal Reserve out through existing channels, going to banks and then different payment providers from there. And I think that's the model that we need to follow. In fact, while there are certainly a lot of different agencies that are involved, the actual legislation that would be required or amendments to existing currency legislation is not all that complicated. And I know that there's folks on the House Financial Services Committee and the Senate Banking Committee that are currently working on some of those issues. And, again, as I said, I think it's important for the U.S. to get this process started and for the Treasury to really take the lead on, what the parameters need to be, and then rely on the private sector for different input. I think once the law is in place, it's going to allow the technology to develop to meet the law's requirements. The technology is somewhat flexible. What we need to do is make sure that we maintain a lot of the values that we have here in the U.S. in the way that our cash currently functions.
And we know that a lot of these issues surrounding consumer protection when it comes to digital assets really arose from the sell-off that we saw in crypto, and really, the government really wanting to get an understanding, because Bitcoin essentially developed because it was to address the unbanked, people who wanted decentralized financing. What sort of gap do you think CBDC will fill, and how do you see it relating to perhaps what we see happening with crypto markets?
Yeah, I think a digital dollar would make transactions faster and cheaper because it would be final and complete in real time. It also allows users to make payments to one another using risk-free assets. This is the same capability that we have, again, in the physical dollar today. It would just be in its digital form. I think cash is the most financially inclusive instrument that we have, and by allowing for CBDCs to be in place, it would allow folks that are currently unbanked to have access to a digital form of payment.
Well, I do thank you for joining us this afternoon. Jonathan McCollum, thank you so much. All right, coming up, a new survey reveals how many US employees are seeking additional hours to combat soaring inflation. Stay tuned for the results.
The FDA announcing that it's limiting the number of emergency use authorization requests for COVID-19 tests that it will review. Now, Yahoo Finance's Anjali Kamlani is here with the latest. Anjali, I think the biggest question here is what this means for consumers who need those tests.
Well, Shauna, I think the important part to point out is that it's not taking these tests off the shelves. It's simply reducing the emergency use authorization, which was put in place, as you know, because of the pandemic. There are now more than 430 different tests out there, and clearly the supply is outstripping demand at this point in time. Of course, we've already talked about how there's an increase in purchases of these tests in the last few weeks. Probably that will continue, but companies are nowhere near where they were in terms of a lack of capacity to produce these. And so at this point in time, it's sort of the FDA pulling back and making sure that all the tests that are out there are actually good ones. There were some concerns earlier on that with the rush to get these to market and to get them in the hands of individuals who needed them, there was some possible quality concerns. And so this would help address that.
And Anjali, the pandemic highlighted some of these stark inequities that exist globally when it comes to the distribution of vaccines, treatments, and other resources. And the WHO began working on a legally binding treaty in 2021 that should have a full official draft next year. Now, you spoke to one of the contributors from the US. What did they have to say?
That's right. Georgetown Law Larry Gostin caught up with me after coming back from a trip to Geneva and just gave me a little overview of what's going on there. And it's really interesting because, you know, there's so much discussion about the equity globally, but here in the US, it's kind of flying under the radar. And the really big impact on pharma companies is set to hit if this does, in fact, go through. Current draft looking at things like sharing of intellectual property and finding a way to solve that problem. That was really one of the biggest hiccups we saw in the equitable distribution. We also know that there's a focus on climate change as well, and pharma companies are in charge of some of these things like fertilizers, and so that really has a large impact on the sector. And as of right now, it seems like the discussion is still happening, but we do have to see how this all pans out and what this legally binding treaty is going to look like for these companies, what impact it could potentially have, and how we might be able to solve the problem in the future. So while things are still moving, the official draft looking to be ready by the end of 2023, according to a World Health Organization official. And so we'll wait to get more details on that. But as of right now, really building out to have a huge impact on the pharma sector.
Certainly a very important story there. Anjali Kamlani, thanks so much.
All right, inflation still near a 40-year high here in the United States. Everything we do, everything we eat, as you know, costs dramatically more these days. And as a result, we're all working more, or at least looking to work more, in order to make ends meet and maintain our lifestyles. And with that, a staggering number. Nearly 70% of Americans said they're seeking additional work to combat inflation. That's according to a new survey by Blue Crew, a workforce as a service platform. Also, nearly 6 in 10 Americans said they're currently looking for or are interested in short-term gig work. That is an astounding number. If you'd have told me that number was at 25 or 30%, I'd have said, Shauna, that is extraordinarily high. 70% of Americans gives you a real accurate picture of how difficult things are right now and why, perhaps, the Fed believes they have to do whatever they can to bring that inflation down, even that it means 1 million to 1.5 million people losing a job. CNN, in a separate survey with Bank of America, showed 70+% of people say inflation is eating up anything they're earning at work. They're not getting a quick enough raise. It is difficult.
It is very difficult. These numbers stuck out to me too. I also think it's even more concerning when you take into account what the Fed is trying to do as it tries to get inflation under control. More people, like you just said, could be out of a job. So if so many people are already feeling the financial strain right now, it could potentially get much, much worse here as the Fed does try to do all it can to rein in inflation. A couple of other numbers that stuck out to me here in that survey. 85% of Americans saying that inflation has impacted their recent spending and also their buying habits. I don't think that should come as a big surprise given the fact that so many are already looking for more hours or second jobs in order to deal with higher inflation. 72% saying that inflation has impacted the view of their job. 57% say that they have sought out new or additional roles over the past year due to the rising cost of living. That just reaffirms the situation that millions of Americans are in right now, how it's so tough when you look at almost everything you buy on a daily basis has risen in price compared to last year. And Rochelle, taking a look at these numbers, so many Americans looking to add on hours, looking to take on a second job, really just paints the exact picture of the current economic picture right now.
No, it really does. And when you think of how we're trying to look at the labor picture, then when you have people working a job, but then also perhaps taking on some of these seasonal jobs, it might muddy the economic picture when you're trying to figure out how the labor market is actually doing. If there's 2 open jobs for one person, but people are then taking on a second job, obviously it makes it more difficult to calculate. And as we look at some of the things that people considered their priorities pre-pandemic versus now, wages and pay, 57% prioritize that. Work-life balance, though, right behind it at 56%. Then that even superseded benefits at 55%. And that even overtook things like schedule flexibility or enjoying what you do. And sadly, over prioritizing your mental health. So people really having to make some very tough decisions and making some really big sacrifices that hopefully don't end up becoming too costly. But it's obviously a very tough space for people right now.
It's a good reality check to know that you out there watching us, I'm right there with you. 70% that would work more or take on a side gig to pay the bills. I'm with you, friends. All right. If you're planning on flying for the holidays, don't wait until the last minute to get your tickets. Find out why after the break.
Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you
Walt Disney World reportedly will close all 4 of its Florida theme parks on Wednesday and Thursday due to expected severe weather from Hurricane Ian, which is currently forecasted to pass over Central Florida. Now, the company had already announced it was going to close some properties Wednesday through Friday, including Disney's Fort Wilderness Resort Campground. In addition to Disney, Universal Orlando and also SeaWorld announced they will be closing for 2 days due to Ian. Dave Briggs, fresh off a plane from Orlando.
Yeah.
He took the trip just in time.
Yeah, got out just in time. We were a little bit worried about it. I know someone here at Yahoo was planning to be there all week, had to cancel. But I will tell you, being in Disney World and in Universal is a reminder that this is the weirdest recession we've ever seen, if in fact we are in a recession. Every park, every ride, everywhere you go, every restaurant is packed to the gills, beyond capacity in some cases. And not just that, it's $174 per ticket at Disney World, but it's the people that are paying to skip the lines and to get the lightning lane, as they call it. Every one of those is sold out and long lines waiting on those. This is a strange time in which either we are not in recession, people saved up and they're just still getting that post-pandemic travel out there, or Disney World and parks like Universal are 100% completely recession-proof. I'm not sure which is the case.
Yeah.
But it was
It's
stunning
expensive.
to me.
Yeah, that is stunning. I was surprised. I actually thought that you were going at a good time since it was right after school started. I didn't think it was going to be that crowded. I thought you guys played it right. So you played it right weather-wise. But I guess it could have, maybe it could have been much more crowded if you hit it during some of those prime spots. But that's interesting.
Times are good.
Interesting to
down
see
there.
whether or not that attendance holds up if we do see more of a severe downturn in the economy. All right, well, speaking of traveling, millions are getting ready to hit the skies this holiday season. And if you're one of those travelers, you better get ready to pay more. Flights this holiday season are expected to be at the highest levels that we've seen in 5 years. For more on that, we want to bring in Haley Berg, Hopper's lead economist. Haley, it's great to see you again. So I guess first, how many people are expected to travel and how much more should people be prepared to pay this year?
We're expecting to see a huge surge in travel over this holiday season. Keep in mind that in 2020 and in 2021, we saw huge depression in travel demand at the holidays. We had the active pandemic in 2020, and then last year we saw the Delta and the Omicron waves knock out thousands of flights over the holiday season. So we know that travelers have pent-up demand for holiday travel, traditions, visiting family, vacations, and we're expecting to see a very busy holiday season. And with that super high demand, we're expecting to see the highest prices, especially for Christmas, that we've seen in more than 5 years.
Haley, if you're trying to determine when is the best time to fly, any tips there?
Absolutely. If you're traveling for Thanksgiving, your best bet is to travel on Monday before Thanksgiving or Thanksgiving Day if you can. Do not try to fly home on that weekend after Thanksgiving. Those will be the busiest airports and the highest prices. With Christmas over a weekend, we're expecting to see a lot of travel dispersed across the days before. So as early as you can travel for the holidays in December, the better off you are in terms of price, but also availability of flights. Capacity is lower this year than it was in 2019, so flights will sell out and they will sell out early.
And Haley, what are you seeing in terms of what people are willing to spend depending on where they're flying to, whether it's domestic or international?
We're seeing right now that airfare for Christmas, for example, is already at about $440 per domestic ticket. International fares over $1,200. And we're expecting those prices to rise as we get closer to the holidays. Unfortunately, something coming out of the pandemic is travelers are planning travel more last minute. And that means it's harder to find deals. If you're not planning far in advance using a price monitoring tool, it's harder to find those one-time price drops or sales that are going to help you get a great deal. So we're expecting that travelers who are planning ahead, either for Thanksgiving or Christmas, they're going to be paying between $300 and $450 for their holiday travel. But those last minute travelers, we're expecting to see prices well over $500 for Christmas and well over $400 for Thanksgiving.
So Haley, how do we use these price monitoring tools you just referred to?
So using a tool like Hopper, where you put in the destination that you're going to and the dates you're traveling and getting proactive notifications about your trip and the price, that's the best way to take advantage of deals. So we're going to do the hard work for you. We're going to be checking the price at 4 a.m. on Saturday and 2 p.m. on Tuesday, every single day, and notifying you what the best price is. Is it available now? Should you book now? That is key. We see at Hopper that travelers who start planning their holiday vacations around now or even earlier will save about 18% more than those who plan very last minute. With prices high this year, that's $80 per ticket or more just by planning ahead and using a price monitoring tool. So download an app like Hopper, get those live updates, and hopefully you will see significant savings for Thanksgiving, Christmas, New Year's, whatever travel you're planning next.
Now, it's interesting because you say, obviously, the last minute bookings for flights, that's a big no-no, but not the case for hotels. Why the difference there?
Yes, this is a little bit of a confusing one for travelers who know don't book your flight last minute. Hotels are very different. So when you're going to a big city, think New York City, Los Angeles, those cities have a tremendous amount of inventory, rooms available to book. So it's harder to sell out a city like New York City, especially over the holidays. If you're planning to go to one of those big cities, booking at the last minute, you're gonna get those price drops that hotels put out there to try to fill the rest of their rooms and probably get a really great deal. So if you're going somewhere big with a lot of hotel inventory, you can wait until the last minute to book your hotel as long as you're flexible on where you stay. The specific hotel you want to stay at may be sold out. So if you can be a bit flexible booking at the last minute, if you are going to a vacation destination, anywhere in Florida, anywhere with a lot of resorts, book those in advance. Those will sell out.
And most of the time at the holidays, we're traveling to a predetermined destination to see family. But if we're not, if we're just looking to get away and to go somewhere warm, how do we find like a great deal if we are, to your word, if we're flexible?
Flexibility is key. It's the best way to get a good price. So using a price monitoring tool is another way that you can see all of the best options available to you. So on Hopper, for example, you can track the price of many different destinations. Say you're interested in a Caribbean getaway. You can track all of the different islands you might be interested in visiting and get live updates of what's the price of this destination versus this one. You know, if you travel a few days later, can you get a better price and go to the same island? So we'll do that work for you. But typically over the holidays, we see that international destinations often have sales or lower prices, given most people are going to that set hometown destination over the holidays. So flexibility is key, but let an app like Hopper do the work for you so that you're not browsing and looking up prices, constantly trying to figure out where's the best destination at the lowest price. That's what our price monitoring and watching does for you.
Haley Berg, Hopper lead economist. Thanks for being here. Appreciate it. All right, let's get over to Shauna with what is moving after hours.
All right, Dave, a couple of big names here. Let's start with what we're seeing from the big banks. Goldman Sachs, Citi, Bank of America, Morgan Stanley, among 16 firms that have reached an agreement with the SEC. They're going to pay regulators $1.1 billion in penalties for failing to monitor employees' use of unauthorized messaging apps. And we know it has been a tough go at it for some of the big banks, at least over the past month in this rising rate environment. Also fears of an economic slowdown. You can see Goldman Sachs off just around 13% in the past month. The Citi down just over 14%. Bank of America off about 10%. And Morgan Stanley, the best of the bunch over the past month, off just around 8.5%. All right, let's take a look at Meta because it was Sheryl Sandberg's last day at headquarters. She got a send-off from a number of her employees, thanking her for the job that she has done for the company over the last several years. She announced back on June 1st that she was stepping down as COO. It has certainly been a rough year for Meta as the company transitions its focus to the metaverse. Year to date, taking a look at that stock, off just around 60% today, right around 52-week lows at 134.40. Let's round it out with MindMed, a huge performer here, or underperformer, I should say, in after hours. Some news here announcing a proposed public offering of common shares, offering those subject to market conditions. We're seeing that stock tank after hours. And of course, just taking a look at a year-to-date chart, it's been a rough go at it for this company, off just around 70%. But even in just the last 3 months, we have seen this biopharma company under a tremendous amount of pressure, off just around 43%. All right, Taco Bell bringing back either the double-decker taco or the enchilada, and you've got to decide which one it is. We've got the details for you right after the break.
Chipotle's tortilla-making robot Chippy is graduating to a real restaurant in October. Chippy will be making tortilla chips in a Fountain Valley, California store. Now, feedback from staff and customers will determine a possible national rollout. And Chippy won't be the only bot in the kitchen. Chipotle is testing AI at 8 California locations that tell staff when to cook based on forecasts of how much of each item the restaurant may need that day. Now, Chipotle's plan for all of these tech innovations is to help staff and customers amid labor shortages. Now, this is an interesting one because a lot of times you think, is automation going to take some of these jobs away from people? But then on the other hand, if it frees them up to perhaps really enjoy customer service, like talking to customers, really making their dining experience better, I'm not mad at it.
Yeah, I think the automation angle has really changed with the way the labor market is right now. You're seeing a shortage across the country in all sorts of restaurants. So it's not really taking away jobs when most of these restaurants at all levels cannot hire enough employees, but their chips are good. So hopefully Chippy does a nice job. Rival Mexican restaurant Taco Bell allowing fans to choose which former menu item will return for a limited time. Brooke DePalma here with the details. Tell me it's those cinnamon crispas. Tell me it's those cinnamon chips.
I am so sorry, but it is neither of those. Reward members actually can only choose between the double-decker taco or the enchilada. So this starts today. Reward members can go on the app and choose. Now, the double-decker taco was introduced in 1995 as a limited-time offering, reintroduced in 2006. The enchilada had a longer run, a 40-year run. It hit the menu in 1970, left the menu in 2013. This comes after the mega success of the limited time offering, the Mexican pizza, earlier this year. Yum Brand's CEO noting that demand for the Mexican pizza was 7 times previous levels, reaching over 20 million pizzas sold nationwide, with some stores selling out within a week, creating a sustained positive halo for the brand. So perhaps Taco Bell allowing members to choose which one will become a permanent menu item. This ends October 7th, and then menus at participating locations will have the chosen winner later on this year.
Well, I was really hoping for the pizza, but both of those options sound good to me. All right, Brooke, Taco Bell is not the only one that's trying to cash in on this nostalgia craze. We got news out from McDonald's. They're trying to sell Happy Meals to adults. What can you tell us?
That's right. So these are Happy Meal inspired, but they're adult meals here. Of course, Happy Meal coming out in 1979. So McDonald's really trying to hit nostalgia as well here. This is in a collaboration with the streetwear brand Cactus Plant Flea Market. So this is a new boxed meal, they're calling it, designed specifically for adult fans. So starting October 3rd, the box will be available in restaurants, drive-thrus, by delivery, or on the McDonald's app while supplies last. Now, customers can choose between a Big Mac or a 10-piece chicken nugget to go into this box, and of course, what they coined alongside their world-famous fries. But here's the catch here. This is in collaboration with that Cactus Plant Flea, so it will also come with one of 4 collectible figurines. The true nostalgic part here, it'll include either Grimace, the Hamburglar, Birdie, or a newcomer, the Cactus Buddy, of course playing on Cactus Plant Flea Market's name. Now, along with this launch, there'll also be merchandise available. Of course, we see McDonald's try this earlier this year with their Szechuan sauce. They also recently unveiled the Cheese Danish. So really looking to tap into Gen Z and capture that nostalgia as well. But I have to ask, are any of you planning to stand by October 3rd and get this drop?
Yeah, buddy.
Why not?
Is awesome.
I
love
like
the Hamburglar.
It's important to hear that this flea market also teamed up with Ye, Kanye West, of course. Yeah. They also collaborated with Supreme, Nike. So these do sell out fast. So if you are planning on it, be sure to log in October 3rd for sure.
All right, thank you, Brooke DePalma there. Thanks so much. This is fantastic. I already like a good Happy Meal because I like the portion size, but they got these like giant Big Macs and too many nuggets. That might be a lot of food for me, but I love the nostalgia. I do love the little toys that come with it. I will
never enough food, Rochelle. Never enough.
Well, that will do it for today's Yahoo Finance Live. But of course, be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the bell. From Dave, Shauna, and myself, have a good one. Bye-bye.
It is Friday, June 17th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Brian Sozzi. We're taking a look at futures here this morning as we are gearing up for another very interesting day that futures are reacting to already right now. And as of right now, you still have the Dow futures holding on to just 1 point. And I say that very strategically because of some of the comments that have come from Fed Chair Jay Powell just within the last 30 minutes here. And so we're going to continue to track to see where the futures point us. But we were up triple digits on the Dow earlier. Right now, S&P 500 futures, you're seeing those up by about 17 points, 0.5% there. And then the NASDAQ futures, tech heavy average, still holding on to gains. But right now, only up by about 0.8% here. We've already seen a lot of activity here early pre-market.
Yeah, you thought we were maybe get a little bit of a bear market rally into the weekend, but Jerome Powell speaking at a Fed-sponsored conference just moments ago, that speech is continuing, really taking us down, to your point. I mean, it looked like we were going to get that rally, but alas, no go.
Yeah, Jay Powell saying, bear market rally, hold my beer.
Hold my beer. All right, here are 3 things you need to know right now. We're coming up on the final day of what has been a crushing week for the stock market as we officially enter a bear market. The NASDAQ has now lost a third of its value after peaking back in November. The S&P 500 could notch its worst week since March 2020. All this coming on the backdrop of a quadruple witching day as stock index futures, stock index options, stock options, and single stock futures are all expiring today. And Brad, that's all fine and good, but I think it is this commentary here by Jerome Powell just moments ago at this conference that really knocked futures, saying they are acutely attuned or acutely focused on bringing down inflation. Now, not new language per se. We just heard from Jerome Powell for quite at length this week at the Fed press conference, came out and raised rates by 75 basis points. But this is a major red flag, I think, to the bulls, because it gives you a sense of what might come as other Fed speakers come out and hit the circuit over the next few weeks. More tough talk on inflation and maybe more volatility for markets.
And look, this has really been Jerome Powell's headline week, right? 75 basis points, that leaked just ahead of the decision to come as well, or ahead of the meeting actually beginning. And so we